The AI story is so dominant right now.
The market is punishing anybody who decides not to play in AI.
AI is going to be a defining trend probably for the next 5, 10, 20 years.
You have to own a little bit of everything, not just tech. Earnings growth is going to be better next year than people expect. Right now, I think it's, we're in pretty good position.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, stocks meet gravity. Equities pulling back following a mega cap tech rally as Wall Street bosses are putting a spotlight on extended valuations. The capital of American capitalism is on the brink of voting in a socialist. It's election day in America.
And a lot of focus here in New York City, especially just because of the sort of local bias. It was very interesting from a local perspective. There is a larger issue at play. We talk all about the K-shaped economy on this show. Every economist comes on and talks about that. How each party is dealing with that is fracturing the insides of both the Republicans and the Democrats. And right now, what you see is a fight for the heart of the Democratic Party in a very real way.
This is true, and it has been for a long time. It's an unequal economy. It's an unequal stock market as well. And we've seen that in the performance of the last week or so, dominated by mega cap tech.
What you're seeing is mega cap tech reporting earnings that have come in better than good and repeating the dominance that we've seen. Yesterday was a great example. ISM manufacturing came in weaker than expected pretty much across the board. The employment component pointed to job losses for the year when it came to manufacturing, the area that was supposed to be the bastion of the economy right now. And so you're seeing the rest of the 493 do poorly while the Mag 7 rally. This has been the story all year. And it's a question of, can it continue or is something going to break?
Broader market's starting to break just a little bit, just like a little bit, a tiny bit maybe. We're down about a 1% on the S&P 500. The pushback begins. David Solomon of Goldman. Technology multiples are full. Morgan Stanley's Ted Pick, a gentleman you know well, Bramo. Markets seem expensive. They say all those things the day after we saw a monster debt issue come from Alphabet. The week after we saw the same thing from Meta.
Yeah, and you saw the pushback yesterday. Massive pushback from the investment-grade bond market. Spreads widened by 4 basis points in response to the latest huge issuance that you see coming out of big tech. Look, they're also talking their book. They don't sound pessimistic, these Wall Street CEOs. They're coming out and saying, it seems like things are a little frothy. No one wants to buy into valuations that are this high, and yet person after person has come on the show and said there is no alternative because ultimately we don't see a reason for this to fall apart anytime soon. So to the extent that they're talking about a 10 to 15% drawback, oh, kel horror. The reality is they're all going to be jumping in to buy that, and it seems like none of them are saying this is something to really cry about.
We'll see if this pullback sticks this morning, at least so far, at 6:02 Eastern Time. Tuesday morning, we're down about 1% on the S&P 500. Coming up this hour, we'll catch up with Henrietta of Deutsche Bank as the equity rally hits a snag. The former New York City mayoral candidate Whitney Tilson as election day arrives. And Torsten Slok of Apollo on the potential for further rate cuts. We begin this hour with stocks pulling back from near all-time highs as Wall Street bosses issue a fresh warning on rich valuations and a possible drawdown.
Of course, it is likely there'll be, a 10 to 20% drawdown in equity markets sometime in the next 12 to 24 months.
We should also welcome the possibility that there would be drawdowns, 10 to 15% drawdowns that are not driven by some sort of macro cliff effect.
Joining us now to discuss, Henry Allen, macro strategist at Deutsche Bank. Henry, I feel like this is a move looking to find a narrative. How would you describe this to clients this morning? What is this pullback so far today?
I think this is actually just a kind of normal, regular pullback that you're going to get in any normal bull run. I mean, at the end of the day, you're not going to hit all-time highs day after day after day. We've had over 30 this year. So getting these kind of pullbacks, which in the grand scheme of this relentless bull run are pretty modest, we're still only around 2% off the all-time highs to the S&P, is to be expected. But, if we look at the macro fundamentals right now, they do remain pretty strong. Clearly, with the US-China trade truce, the risk of near-term tariffs has been taken off the table. We still have the tailwind from the recent Fed rate cuts, another 50 bips already this year, even if they don't cut in December. And actually, a lot of the activity data at a global level has been pretty good. I was struck, for instance, in Europe, that the flash PMI, actually, the composite PMI was at a 2-year high. So actually, the ISM manufacturing yesterday, yes, a little bit weaker than expected, but, I appreciate the data has been limited out of the US, but that has actually been the exception rather than the rule. And I think that fundamental bullish backdrop does remain in place.
Henry, at the same time, I think we have to take note when a stock falls on good news, not bad news. Palantir and the earnings from Palantir wasn't bad at all. If you go through the numbers relative to expectations, then you see the move this morning and the stock is down by 6 or 7%. Does that speak to full valuations? What do you think that speaks to?
I think you always get these moments where single headlines can create a lot of fear. I mean, I remember back in early in the year, before the Liberation Day turmoil, we had the DeepSeek AI model released, and there was a very big temporary pullback in tech stocks that proved to be very short-lived. People thought this might be a new big narrative shift, and it wasn't. But, thinking about those CEO warnings you played just before this, if you think about what has generated, 15% drawdowns for the S&P in recent decades, it's usually taken one of three things. One is a recession, which there's no sign of yet. The Atlanta Fed's GDP tracker actually at 3.9% in Q3. Another is fears of a recession, like we saw after Liberation Day, but no one's seriously talking about a recession right now. And the other third component that has gone with that is Fed rate hikes. So a lot of the sell-offs we've seen in recent years, so 2015-16, late 2018, and indeed 2022 most notably, have gone hand in hand with Fed rate hikes. But they're not talking about hiking anytime soon. And if anything, obviously with a new Fed chair coming in next year, the direction of travel remains pretty dovish.
We'll talk about the Fed in just a second, but it's not just the big Wall Street CEOs that are talking about this. I actually took more notice at a story that came out this morning that Michael Burry of the Big Short fame is shorting Palantir and Nvidia shares. And he's coming out and talking about valuations, but he's also kind of leaning into a narrative that an increasing number of people have talked about, which is this K-shaped market can't continue. You have to see some monetization of the software, of the hardware, in order to keep this AI trend going. Do you think there's validity in that maybe some of the winners need to take a pause and there needs to be a transfer in terms of stock market leadership?
I think to some extent there is, but I think a lot of the comparisons to the dot-com bubble are really quite over-egged at the moment. So, for instance, the Nasdaq is up by 23% year to date so far. Now, that's very healthy. But in 1999, we had the Nasdaq up 85% that year. And in the final 7 or 8 months of the dot-com bubble, the Nasdaq literally doubled. So I don't think the gains we're seeing, can really be compared to what we saw at the time of the dot-com bubble. And another key difference between now and then is back then, a lot of the assumptions that valuations rested on was a belief that 4% growth, as we saw in the mid to late 90s, would continue forever. Forecasts from reputable people like the Fed were saying that would continue well into the 2000s. But then, as we know in retrospect, we had that downturn in 2000, 2001, and there was a recession. Whereas again today, valuations are not resting on continued 4% growth forever. We're kind of in a 2.5% to 3% range, perhaps with some upside if AI productivity does lead to a boost. And again, there's no recession on the horizon. So clearly, if that macro picture changes and we do get a growth downturn, then I think that would take some of the underpinning away. But for now, we're not seeing those relentless, remorseless gains that we saw at the time of the late 90s.
You talked about the other catalyst, the potential catalyst for an end to the rally, which comes from the Fed and a potential tightening in Fed policy. Seems like that is nowhere on the table, as you were mentioning. You did say that maybe inflation is underappreciated, and that's something that Deutsche Bank has been talking about quite a bit. What makes you think that, based on the ISM manufacturing, which was the opposite, based on the fact that there is this K-shaped economy that has put pressure on any additional price gains that we've seen in the consumer sector?
Well, I think there are still a lot of inflationary catalysts. I think the market has been a bit too reassured by the US-China trade truce we saw last week and some of the other recent data. But at the end of the day, for instance, tariffs, very still much in the picture. I know we associate a lot of the tariffs that have come in with April time, but actually a lot of the tariffs, for instance, the 15% on the EU and Japan, the 10% increase on Canada, the sectoral tariffs like copper, a lot of those tariffs only came into effect in August. And the data we've got only goes up to September. So that's still going to be a theme as we move towards year end, the Q4 data, and into 2026. On top of that, we still have the lagged impact of all the rate cuts. Indeed, it's worth bearing in mind the Fed have now cut rates by 150 basis points since September last year. That is the fastest pace of rate cuts outside of a recession since the 1980s. This is not a framework that we've been used to in recent times. You've got momentum there too. The activity data, still proving pretty resilient, so that suggests demand pressures. And at a global level as well, you've got factors like the European fiscal stimulus coming in. So, as I look around the world right now, including in the US, I think there's actually still a lot of inflationary catalysts on the table. And I think markets risk ignoring that on their peril, because if we do see inflation start to tick up again more than markets expect, I think the risk is we get a similar hawkish surprise to what we saw last week, where markets were surprised when Fed Chair Powell took that December rate cut a bit off the table, put it in some doubt.
Henry, I know that Deutsche Bank just re-entered a short position on 10-year treasuries and have a target of 4.45%. I'm just wondering, is that enough to continue the sell-off that we're seeing this morning in risk assets, given the underappreciation, as you've been saying, of inflationary risks?
I mean, that's an interesting question. I think the key question, particularly as we move forward into next year, is do we get that reacceleration in the economy? Because one thing I've been struck by in this post-COVID cycle is that consistently, particularly in the US, the macro picture surprised on the upside. So even in 2022, though we had the fastest Fed rate hikes in a generation, which previously had always led to recession, they pulled off the soft landing just about. Then in 23 and 24, we had stellar equity gains. You know, the S&P 500 rising back-to-back 20% for the first time since the late 90s. So again, that macro picture has been very strong. And again, this year, you know, even though we had genuine fears of a recession around Liberation Day, the biggest trade shock since the 19th century, again, the economy has been remarkably resilient. So actually, I do think there is upside potential for yields as we look forward to the rest of this year into next year. And actually, I'm struck that last year when the Fed cut rates, actually, it was the point they were cutting rates that actually proved to be the low for yields. From then onwards, they picked up again. So I definitely think there's a valid case for that.
Henry, enjoyed this. Thank you, sir. Henry Allen there of Deutsche Bank. Henry touching on something super important coming out of the pandemic. We have consistently underestimated the strength and resilience of the US economy, and we've done it time after time.
Yeah, and this is the reason why some people are saying that maybe the inflationary concerns are going to cause some sort of sell-off in bond markets that have been pretty quiet. I mean, we've seen the Fed cut rates, and we've actually seen bond yields in the long end go down. So here's the question. Is the resilience in the right parts of the economy to allow inflation to keep going up? Because there is a huge bifurcation, and we keep talking about it, and we'll keep talking about it throughout the morning.
Bond yields down so far this morning by 3 basis points at the front end of the curve. We're down 3 on 2s to 3.57. On 10s, we're down 2 to about 4.1%. That's the price action. Let's get you an update on news worldwide with your Bloomberg brief. Wall Street executives warning of an equity pullback. Goldman Sachs CEO David Solomon and the Morgan Stanley boss Ted Pick expecting a 10 to 20% correction in equity markets over the next 12 to 24 months because of, quote, challenging valuations. Elsewhere, President Donald Trump is threatening to withhold federal funding from New York City. It's a last-ditch effort to drive the city's voters to the former New York Governor Andrew Cuomo, and prevent Zohran Mamdani from winning the mayoral election. And finally, U.S. Secretary of State Marco Rubio reportedly helping persuade the president to leave NVIDIA chips out of last week's trade talks with China. The Wall Street Journal reporting that Rubio warned selling top-tier chips to China could pose a national security risk. That was in focus, Bramo, last week. That's why it didn't happen.
Yeah, and the idea that there are multiple voices pushing the win for Rubio versus Jensen Huang, who still is coming out and saying, we hope that he'll come to his senses and let us do this. And the rest of the administration is saying, please don't. So let's see how that battle continues.
It's good to see that Rubio's still in charge of foreign policy and not the NVIDIA boss, right?
For now. I mean, let's see.
At least that's something. That right there is your Bloomberg brief. Up next on the program, Election Day in New York City.
We know and have known for months that Donald Trump would favor Andrew Cuomo as the mayor. They share the same small vision.
Trump will go through Mamdani like a hot knife through butter.
Governor, do you accept
and we can't have that.
Up next on the program, the former New York City mayoral candidate, Whitney Tilson, joins us next from New York City this morning. Good morning. Live from New York City, welcome back to the program. Equity futures rolling over. We're down about 1% on the S&P 500, negative by 1.3 on the NASDAQ, on the Russell down by 1.3. If you switch up the board and get to the bond market, it's pretty defensive this morning. Equity selling off, bonds a bid. Yields are lower by 2 basis points, 10s at about 4.08%. Lisa 2s back to about 3.57.
Yeah, and it follows what we saw from ISM Manufacturing. You could say it's ISM Manufacturing. It's not the big employment report. And guess what? It takes on that much more importance because we're not getting the big employment report. So here's the question. Are these peripheral data points indicating a real weakening in the underlying economy that's led to this K-shaped type of market in addition to a K-shaped economy?
That's the latest on the data front. ISM services still to come this week, about 24 hours away. Equities not doing so well this morning. Coming up on the program, under surveillance, Election Day in New York City.
We know and have known for months that Donald Trump would favor Andrew Cuomo as the mayor. They share the same donors. They share the same small vision. They share the same sense of impunity.
Mamdani cannot handle Trump. That's clear. And the next mayor has to be able to handle Donald Trump. Trump will go through Mamdani like a hot knife through butter. And we can't have that.
So here's the latest this morning. A record number of New Yorkers already casting early ballots for the city's next mayor. President Trump announcing his support for Andrew Cuomo, who is running as an independent, and threatening to withhold federal funding if frontrunner Democratic Socialist Zohran Mamdani turns out to win. Whitney Tilson is a former hedge fund manager and was a 2025 New York City candidate in the Democratic mayoral primary. He joins us now for more. Whitney, good morning. It's good to see you.
Good morning. Thanks for having me.
Thank you for being here. What's at stake today?
Well, it's a big day for New York. I think there's going to be a big surge in turnout, and I'm glad to see New Yorkers are getting politically involved. Early voting was 4 times what it was 4 years ago. I wish that didn't favor Mamdani, but it probably does, as it did in the primary. But the polls show the race is tightening. It was 15 points, and now the latest poll, just yesterday, it's under 5 points. So it's not completely impossible that there could be a big election day surprise, though Mamdani's clearly up 5 is still a good place to be going into election day.
You're familiar with the headline on Wall Street that the capital of American capitalism is lurching towards socialism.
Yeah.
Does this tell you more about the mood of the country or the mood of the Democratic Party?
Well, and also it tells you something about the candidates. Mamdani is a gifted politician. He identified the key issue for New Yorkers is affordability, and he came up with some very clear, freeze the rent, free buses, free childcare, very easy slogans. And one thing I learned as a politician, if you want to win, promise the maximum number of people, the maximum amount of free stuff, and tell them they don't have to pay for it. And he nailed that, and he's been on message. And Cuomo thought he was going to coast to victory in the primary, and really didn't even campaign out there. And by the time I was raising the alarm in the late stages of the primary, it was too little too late.
It's simplistic, though, to say that it's just promising people freebies, and that's what got some of the attention. It's also that what Zohran Mamdani was talking about wasn't just the anti-Trump platform. It was the idea of trying to identify some of these needs. Have you been disappointed that the Democratic Party hasn't done a better job of crystallizing those issues and running on that and not an anti-Trump message?
Yes, very much. And I don't think it's just here in New York we're seeing it. We're seeing it nationally. I'm a lifelong Democrat. I ran the Democratic Party to try and drag my party, back to the center, to bread and butter issues for people rather than social issues and just attacking Trump. And Mamdani, to his credit, hasn't spent a lot of time attacking Trump. That was not his. It was affordability and a few key ideas. And in the same way, from the opposite side, he's a little like Trump. Trump was, we're going to build a wall and Mexico's going to pay for it. And I don't think his supporters it actually believed that, but it was a clear message on the issue that they cared about. And Mamdani took a page out of that book and has executed superbly. I got to tip my hat to him.
One thing that you do really well is that you're at the crossroads of Wall Street and the political scene. And I'm just wondering how realistic you think some of the threats are by your colleagues of leaving New York City if Zohran Mamdani should win.
That will depend on whether he governs as he has in the past few months, as he's promised to, sort of tacking to the center, and said, I will protect the Jewish population of New York despite his dangerous rhetoric in previous years. I will not defund the police, and to his credit, said he will keep Jessica Tisch. I'm going to embrace entrepreneurs and businesses as opposed to government seizing all means of production, which is what's on his political party. The Democratic Socialists of America says that. So I'm cautiously optimistic, hopeful, I would say, that if he is elected, he will try and govern from the center, keep us safe, and keep New York the incredible center of entrepreneurship and finance and trade and all. But there is a risk that, a 34-year-old guy who's grown up with the rhetoric of the far left, if he governs as a radical, I think people will flee the city and businesses.
Elisa, it's already happening. You've been seeing it now for years. I think a great stat is that JPMorgan Chase now has more employees in Texas than it does in New York State, which 10, 15, 20 years ago might have been shocking to some people. But That's the reality of America in 2025.
A lot of it has to do with taxes. A lot of it has to do with certain business practices that haven't been as friendly. How much does this accelerate that move, as we've seen? And how much is Zoran Mamdani, if he does win, going to be sensitive to that, to want those people to remain an income base for the city?
It's not just making the city more competitive with global capitals. It's making the state more competitive with the other states across this country, which goes to Lisa's question. What's going to stop people from moving? Whitney, when you were going out there and campaigning, what are you campaigning for? What would you like to see change in this city, in this state, to make sure we attract the best of the best, not just around the world, but in this country too?
Yeah, well, it starts with public safety and not defunding the police. Defund and dismantle the wicked police are all things Mamdani had on his website. And I said, we need to do the opposite. We're at a 34-year low in the number of police officers, and we need 5,000 more police officers. I was going in the other direction on public safety. And then secondly, look, economic growth is the key to everything. It's the key to paying for all the things Mamdani wants. And I would love to deliver free child care to every New Yorker as well. It's that cost is crushing people, but you got to be able to pay for it. So under Mike Bloomberg, the taxes doubled, but that's because the economy doubled during his 12 years. Under de Blasio, economic growth slowed from 6% a year to 2% a year, and all of a sudden we're running budget deficits. So creating a business-friendly environment is critical, and unfortunately Mamdani's rhetoric is sort of the opposite, and rhetoric matters when it comes to making long-term investment decisions about where to locate your business, whether to invest in building and hiring people and so forth. That was a key part of my platform, but it turns out just affordability and promising lower costs in a few areas was the winning message this year. And Mamdani executed on it superbly. He was on message.
I mentioned JPMorgan. Jamie Dimon talked about Bill de Blasio, and he said something like, we survived Bill de Blasio, we'll survive this. Yeah. Is that too simplistic?
No, it's my model that my working scenario going forward is Mamdani will be de Blasio 2.0. Little left, too far left for me, but de Blasio did not mess up this city. New York is still doing incredibly well, and I'm actually much more optimistic on New York, having run for mayor and spent 7 months in every corner of the city. We're an incredibly rich, dynamic, entrepreneurial city, and I'm confident Mamdani is not going to drive everybody out and mess it up.
You know, this is sort of a sensitive question, but are you surprised to the degree that the politics around the Middle East are driving voters in New York City to a large degree?
Not really, because New York has the second largest Jewish population outside of Tel Aviv in the world. It's about 10% of the population here. And my wife and children are Jewish. We've been members of Central Synagogue for 25 years. And Central Synagogue, anytime you go to services now, there are not just a few police officers. Like, there's paramilitary people out there protecting us. We have to go through metal detectors. It's a fortress because of these mobs and the rhetoric, the anti-Israel rhetoric that Mamdani is trafficked in. You don't have to go very far before it becomes anti-Semitic, and some of these people are committing violent acts against New York's Jewish community. So it's a big issue. It's one I hit Mamdani hard on during the primary. And again, to his credit, he has said that, job one for me is going to be protecting all communities that are under threat, especially the Jewish community. I'm hoping he delivers on that.
Whitney, it's good to see you.
My pleasure.
Thanks for making time for us. We appreciate it. Whitney Tilson there, the former New York City mayoral candidate. It is election day here in New York City.
Yeah, and also in New Jersey, and also in Virginia, and also in California. A real question for the battle for the heart of the Democratic Party, and frankly, a question of whether this will be a referendum on what's been done so far over the past couple of years. Honestly, there is a fissure in both parties right now, and it has to do with the economic issues that we've been talking about, that K-shaped economy, and how there is disagreement over how to address it.
We've got to go way back and start with education. What happened in this country? Why are highly educated, wealthy, privileged kids voting for socialism with a complete lack of awareness about economic history and the last 50, 100 years every time that experiment has been tried?
It's actually a great psychology experiment. There are a number of studies. We can get into them, but I actually have been reading about this. It's pretty fascinating.
We'll have some fun at the commercial break. From New York City this morning, good morning. You're watching Bloomberg TV. A A two-day rally hits a wall this morning. We're down by 1% on the S&P 500, on the Nasdaq down by 1.3. Kicking off November, adding to October gains, but some very narrow leadership on Monday. Through to Tuesday, the pullback continues across the board on the Russell. We're down by 1.3%. In the bond market, yields pushing higher through yesterday's session, down this morning by 3 basis points at the front end on 10s. We're down by 2 to 4.089%. Data hasn't been great in the last 24 hours. In the next 24 hours, more data still to come. ISM services very much in focus.
Especially given the fact that ISM manufacturing isn't proving the sort of bastion of growth that some people were expecting. Do you see the same kind of softness, particularly on prices paid in services? Because prices paid went down when it came to ISM manufacturing, and it was in contractionary territory. None of this is talking to runaway growth or inflationary pressures that a number of people have been worried about.
What do you think was kicking around the Treasury market yesterday? Fed speak, data, or just the amount of issuance coming from corporate America? And by corporate America, I mean mega cap tech, Meta, Alphabet in the last week.
Call me a skeptic, but I don't think that the Fed speak is actually what's doing it, because right now it's hard to know how much of a difference any one person is going to make, given the fact we know the committee is split. So I don't want to put too much tension there. The glut of issuance has to be front and center, especially at a time when people are increasingly worried about high valuations. And you did see a little bit of digestion issues. I mean, this is like 1 ton. This isn't exactly like the full Prilosec, but this idea of 4 basis points of widening in the investment grade credit spreads speaks to the glut of issuance.
$90 billion of demand for a $17.5 billion debt issue coming from Alphabet yesterday, and they threw in some euro-denominated debt as well for good measure.
Why not?
Some unreal numbers coming out of that market. As we count you down to the opening bell a few hours away, about 3 hours away now, let's get some morning movers for you with Yahara. Hey, Yahara.
Hi, John. Palantir delivered one of its strongest quarters yet, with soaring sales and a higher outlook, but you wouldn't know it by looking at the stock. It is down 6.4% in the pre-market as investors grow increasingly worried about its sky-high valuation, with its price-to-sales ratio sitting at 85, the highest in the S&P. So analysts in note after note are warning the numbers may finally be too rich, even for one of AI's biggest winners. And we move on to Tesla. The risk-off mood translates to that as well, down 2.3% after Norway's sovereign wealth fund came out against Elon Musk's proposed $1 trillion pay package. The fund cited concerns over the size of the award, dilution, and Tesla's growing reliance on Musk's leadership, highlighting some of the investor pushback we've seen from ISS and public pension funds ahead of that key vote this week. And we end on Denny's. Those shares are soaring nearly 50% after the diner chain, known for its Grand Slam breakfast, said that it's being taken private in a $620 million deal. This adds to the wave of companies we've seen leaving public markets as investors look to whip up value outside of the Wall Street spotlight. John?
Yahara, thank you. Appreciate it. More from Yahara in the next hour. On our radar this morning, some breaking news. In just moments ago, the former Vice President Dick Cheney has died. He was 84. Cheney served as the 46th Vice President of the United States from 2001 to 2009 under President George W. Bush. That news coming in just moments ago. Any further updates, we'll bring them to you. Elsewhere, it's election day. In the U.S. and New York City, voters will be choosing among Democratic candidate Zohran Mamdani, former New York Governor Andrew Cuomo, and Republican Curtis Sliwa to be the next mayor of the city. And finally, stocks pulling back this morning as Wall Street CEOs are waving a red flag for investors, warning an equity market drop of more than 10% could be coming in the next 12 to 24 months. Due to sky-high valuations. Stocks are down across the board this morning. It must be frustrating to be a CEO on Wall Street because you make headlines even when you just state the obvious, right?
I mean, 10 to 15% is almost like a knee-jerk kind of response. Yeah, sure, I could see the market going down 10 to 15% every 12 to 25 years. It's sort of like saying there's a 20% chance of recession. There's always a 20% chance of recession if you're an economist on Wall Street. Nonetheless, it speaks to the idea that we are seeing sky-high valuations. And you pointed to Palantir. I think it's a valid point. The fact that they've gained 150% so far this year. Palantir shares have been on a tear. They delivered another beat for the 21st consecutive quarter. The CEO said we are in a nosebleed zone. No one else is here. And the stock sold off, not because they didn't deliver, but because people are just worried about how far and how fast this has run.
I think it's fair to say that when a stock falls on good news, it tells you something about valuations
100%.
And how much we've rallied. And Palantir news yesterday, if I'd just given you that, didn't even show you the market move and just gave you what Palantir said, there's no way people would come out and say that was a bad earnings report.
They have a run rate of $4 billion, and they're talking about 63% growth This is crazy in terms of any type of other company that is of similar size. So you start looking at this type of growth and you start saying, well, maybe the valuations are warranted. At the same time, a lot of this is a guessing game. And the guessing game has gotten pretty frothy. And I think that's the reason why people are getting nervous. And frankly, the reason why some of the CEOs might welcome a sell-off rather than just simply this steady march upward.
Palantir down in the pre-market. Broader equities on the S&P 500 negative by 1%. Let's turn to trade. President Donald Trump deciding against allowing Nvidia to sell its top-of-the-line Blackwell chips to China ahead of his meeting with Chinese President Xi Jinping just last week. The Wall Street Journal now reporting Trump made the call after advice from top officials to protect U.S. national security. Joining us now to discuss, the former NEC Deputy Director, Everett Eissenstat. Everett, welcome back. This is, I think, for many people, particularly down in Washington, D.C., promising news that the president was responding to the advice of his State Department and not the advice from the Nvidia boss about what he would like to see. Is that welcome news for you?
Well, it's always good news when you have the experts weighing in on national security matters, and that's what they're there for. They're there to advise the president and give their best counsel as to what's in the interest of U.S. national security. The president always has listened to his advisors. Of course, he's the ultimate decision maker, and at this point, he decided that this was not the time to do this. So I think those who are concerned about national security risks, technology transfer to China, are going to be heartened by that decision.
Everett, do you think it's case closed, or is there still an open debate down in Washington?
It's never a case closed. This debate, it's a continuation of a conversation that's been going on for years. Is what's the appropriate level of technology? What's the type of technology? And it's a real tug of war between trying to sell and supply the world with our best technology, which we've created and earned, and also being sure that it's not getting in the hands of folks who are going to do things that are not in our national interest. So it's a continuous debate, and one that's going to continue to play out.
Everett, what do you make, though, of the idea that it's a national security issue not to provide China with some of these high-end chips because it will prompt them to move away from U.S. technology, deploy their own, and create an alternate system that could potentially be more of a threat than if we just gave them those chips? I mean, this is the argument that Jensen Huang has been making. Do you find it credible?
I think there's always a balance between how much control you contain over your technology and whether, I think you can also say it the other way, that if the other party has the technology and they're using it, they may be able to accelerate their imitation of that technology more rapidly. So I could see both sides. It's never really a super clear one or the other. There's always a balance there. So I'm not sure that withholding the chips necessarily would enable them to accelerate faster. I could even make the case that it might delay them or not having those chips.
Everett, there's also this issue right now that people have been rather sanguine about, that tomorrow we do get the Supreme Court decision, or arguments rather, not the decision, around the legality of the tariffs that Trump has put on. And I'm just wondering whether there really is a huge economic risk, as President Trump has said, if these tariffs are overturned, or do you think that there is an infrastructure of other levies that could take its place in short order?
Yeah, this is a big case. I mean, this is significant for a number of reasons. I mean, the president's really built much of his economic platform, both domestic, international, and even the foreign affairs, on tariffs. Now, he's been using several different statutes to do that. The one that's being debated here before the Supreme Court is the International Emergency Economic Powers Act. If that is struck down, it will limit the president's ability to impose tariffs as quickly as he has, although there are other tools. So directly to your question, the president can make up this tariff authority through other means. There's a lot of other statutes out there he could use. Some have been rarely used, just as IEEPA had been rarely used before the president took office for tariffs this cycle. So there's a lot of other ways he could do this. So the tariffs are going to continue. But this case is very significant. It's going to have a big impact, as you noted, not only on the amount of revenue that's sitting there, but also on the ability of the president to really wield power in a very, very effective and efficient way. And it will have some constraints on that authority.
So, Everett, can I just pick up on the significance of this? What is the difference now compared to where we were in the president's first term? Why has he chosen to govern differently and use different tools to address the same problem?
No, it's vastly different. I mean, in the first term, we were talking about limited use of tools for very discrete purposes. We were using 232, a statute that targets imports on national security grounds to limit imports of steel and aluminum into the United States. And obviously the 301 on China was very focused on China, on intellectual property rights, technology transfers, and unfair practices there. You compare that to where we are today, not only are the number of statutes being used, but the reasons and the rationales behind those statutes has expanded dramatically. We've seen them use everything from, putting tariffs on kitchen cabinets because the timber, the steel and aluminum, 301 tariffs potentially on Brazil. We've seen tariffs on India over secondary sales of Russian oil. So it's a vast expansion of tariff authority used by a president, and it's never been done in my lifetime. And I think you'd have to go pretty far back to find a similar dynamic in our history. It's quite dramatic.
Everett, as Lisa pointed out, we'll hear arguments. Might not get a final decision until the end of the year, maybe. But Everett, can you describe the period after? If this is struck down and we have to move in a different direction, what do those months, quarters, years look like in the president's second term for trade policy?
They're going to be I don't think they're going to fundamentally change. The policies will not change. They may be modulated a little bit. He will have to find a different way to achieve the same objectives. And as I noted, there's tools to do that. So he'll be able to recoup the revenue. He will be able to impose tariffs under other statutes. He'll be able to reshore manufacturing, raise revenue. I think one of the key questions is if the statute is ruled unlawful in this instance, what will the Congress do? And will the Congress come in and modify that statute? Will the Congress come in and perhaps retroactively approve the framework agreements that the president has negotiated? It's a really interesting dynamic because the authority the president has used for those framework agreements with countries like Japan and South Korea, United Kingdom, they are driven by tariff authority. That was the leverage, but they aren't necessarily sustained by that. The president has his foreign policy power. He has that executive authority. He's used it for those framework agreements. Will some of those be renegotiated? Will they be approved by Congress? We'll have to wait and see. But it's going to be a very significant ruling. And I think in many ways, once the ruling has been finalized, we'll probably get more certainty as to the route of the administration for the remainder of the term. So it's going to make for some very, very interesting dynamics.
Everett, appreciate it. Thanks for jumping on. Everett Eissenstat, they're the former NEC Deputy Director. This market wanted to move on. Just shows the rules of the game. This would reintroduce a lot of volatility around policy and decision-making for the years to come.
And your question about what do the months after the ruling look like if it is overturned is a really important one because a lot of people think that they can come up with some sort of system of other tariffs under jurisdictions that will compensate for that revenue. And that's the reason why the Treasury market's not going to sell off. We'll see, right? We shall see.
That could be a messy few months, that's for sure. If you are just joining us, welcome to the programme. Equities recovering a touch. We're still negative across the board on the S&P 500, down by about 1%. Let's give you an update on stories worldwide this morning. Here is your Bloomberg brief. Apollo Global Management reporting third quarter earnings that beat estimates. Apollo seeing a 23% jump in fee-related earnings. Its assets under management topping the $900 billion mark for the first time. Elsewhere, BP is trading lower in London trading despite posting earnings that beat analyst estimates. The company saying operational improvements and higher oil and gas production outweighed lower prices. And finally, British Chancellor Rachel Reeves paving a way for tax hikes. Reeves blaming the previous Conservative administration and global trade frictions for hurting the UK economy. She's also pledging to cut UK debt costs. And that right there is your Bloomberg brief. Bramo, you caught up with Chancellor Reeves in the past few weeks. Those excuses are starting to sound a little bit stale now, aren't they?
I won't comment on the discussion around it, but it was very strange. It felt like asking one question and someone knows what you're asking and they just completely answer their own thing. And it doesn't happen that often. I think it's clear she thinks she's in a really tough position. She isn't being fully transparent. She didn't reiterate her pledge not to raise taxes more broadly. There is a question of how much she wants to build her buffer. Is the UK an anomaly, an idiosyncratic story, or is this something that really is a template for what could come of other countries?
The tax and spend doom loop is not one you want to go into, and it's looking more and more like they might have gone into it. It's a problem for the UK.
Watch this space and watch gilts. This is what people want to see.
Up next on the programme, building the case for a jumbo rate cut.
What matters for the stance of policy is where you are relative to the neutral rate. I think that we're a fair way from neutral, and I think that we could get there a bit faster. I could imagine getting there in a series of 50 clips.
That conversation up next with Torsten Slok of Apollo. Live from New York City this morning. Good morning. You're watching Bloomberg TV. Stocks are down this morning across the board on the S&P 500, down by 1%. On the Nasdaq 100, we're down by 1.3. Similar move on the Russell. Under surveillance this morning, building the case for a jumbo rate cut.
What matters for the stance of policy is where you are relative to the neutral rate. And if neutral is here and policy's up here, you're very tight. If neutral's here and policy's down here, you're very loose. But if you stay where you are and then neutral goes down, you've passively tightened because the neutral rate has shifted. And so policy has grown tighter over the course of the year. I think that we're a fair way from neutral, and I think that we could get there a bit faster. I could imagine getting there in a series of 50 clips.
So here's the latest this morning. Fed officials explaining their views after a very divided October interest rate decision. Joining us now to discuss is Torsten Slok of Apollo. Torsten, good morning to you, sir.
Morning.
Super divided Federal Reserve based on the communication we've had so far from the committee following that decision. This line here from Governor Meera to us just yesterday, that we're a fair way away from neutral. I think we could get there a bit faster. How close are we to neutral?
Well, the key question here, of course, is are we doing monetary policy according to some framework with R-star or some forecast, or are we doing monetary policy according to data dependency? Because it's very clear that a lot of the arguments that are being laid out for more cuts, of course, is really dependent more on the forecast, or is dependent on some framework about what do you think R-star is. So the discussion about R-star, which we now have had for many years, of course, is very clear. There's a lot of uncertainty. So with that backdrop, yes, some estimates are low. So you could argue that those are the ones you should be focusing on. But it's very clear that the divide really here among FOMC members in the last few days has been around, should we focus the policy decisions today on R-star and some forecast that we may have, or should we focus it on the incoming data?
Well, let's talk about the incoming data. How can we forecast anything if we don't really know where we are at the moment?
Well, we do have CPI, of course, before the last FOMC meeting. But what we also have is that a number of indicators for the labor market are also still showing that things are actually still okay. If you look, for example, at the macro edge job announcement cuts data, that's still okay. The Challenger Gray and Christmas job cuts data is actually also still okay. If you look at ADP, job creation is also okay. If you look at Revilio Labs, also job creation, also okay. If you also look at paychecks, that's also link up. That's also indeed job openings. Taken together, all these indicators are not showing a labor market where the bottom is falling out. So that's why the conclusion from Jay Powell last week was very clear. Inflation is still around 3. The labor market is still okay. So with that backdrop, what is the argument for cutting rates, at least when you look at it from a data-dependent perspective?
The argument is that you are passively tightening, as we heard from Stephen Myron yesterday, because of the demographics and because of the fact that inflation is coming down. And with a labor market that's okay, but relatively fragile in certain corners, why not give them a little bit of support if you are above neutral to get back closer to neutral? What do you make of that argument?
Because there's also a broader discussion around, it's not only about the Fed funds rate, it's about financial conditions more broadly. And if you look at my Bloomberg measure of financial conditions, it still shows me that financial conditions are very easy. So in that sense, companies, especially in the AI space, they're not borrowing as a function of the Fed funds rate. They're borrowing as a function of equity prices. And given where equity prices are for the Magnificent Seven, that's very importantly coming a very significant tailwind still to the economy and still even to hiring, simply because we now have that equity financing is getting huge help from the fact that equity prices are still as elevated as they are at the moment.
You've done a great job of talking about the K-shaped market. And this is sort of the conundrum for the Fed. They've got this blunt tool of cutting rates. And there's this question of, does that help the lower income consumers and companies that are catering to them more than it really risks creating a bubble in the AI names and those areas where financial conditions are very loose? How do you weigh in on that?
That's exactly right. And that's why what becomes exactly critical, Lisa, is to think about what is the weight in aggregate consumption from the bottom 20% of the population, which is roughly around 8% of total consumption, whereas the top 20% accounts for 40% of total consumption, according to the Consumer Expenditure Survey. So because of that, it still is the case that when stock prices are up, home prices are up, and when interest rates are high, the cash flow for those who own debt, who own private credit, is still strong. So for those households at the upper end of income distribution, things are still looking good. And that's a very important reason why the consumer still continues to do well. And critically, it's not only a K-shaped economy for the consumer, it's actually also a K-shaped economy for the corporate sector. If you look at EPS expectations since the beginning of the year, Magnificent 7, the expectation is that earnings will grow further. But for the S&P 493, earnings expectations have actually come down. Likewise, the same thing for profit margins. For the Magnificent 7, it's going up. For the S&P 493, profit margins expectations have been coming down. So we're seeing more signs of the K-shaped economy, not only the division in terms of the consumer side, but also on the corporate side, where it's more and more the AI story that continues to drive everything.
Do you see limits to that trend?
Well, the key issue, of course, is to what extent on the AI story, of course, the AI companies that the Magnificent 7 can continue to deliver the earnings that are priced in at the moment. If there, for whatever reason, is any slowdown in earnings growth in AI, it will certainly begin to create some wobbles, not only in the data center build out and also, of course, the challenges on the associated energy side, but it will also begin to have some wealth effects, especially if we do get the correction that we've had some conversations about in the last several 24 hours.
Yeah, just to think through this in the ultimate extreme, you need someone to have a job to buy the product you're selling, like ultimately, don't you? And the fact that we've seen some decoupling between employment and corporate profits, I just wonder how much longer that can persist.
Well, a very important part of that is indeed that immigration has been slowing down. So the Dallas Fed is now saying that the equilibrium non-farm payrolls is 30,000. So think about the ADP that came out last week. The monthly number was around 50, 60,000. So that means that suddenly we have that 50, 60. It's actually not too bad when you think about that suddenly the Fed is telling us that the new going rate where we should be is 30. So from that perspective, we can have a slowdown for immigration restriction reasons, also the 100,000 on the H-1B, that will slow down job growth and therefore still create a labor market that's just having slower growth in jobs, but not so much because the economy is slowing in GDP, but simply because immigration inflows are a lot weaker.
Torsten, if the Fed were to cut by 25 basis points, does that cause the K-shape to get wider or narrower?
So that depends on, of course, for the consumer side, if we continue to have a rally in the stock market, if we continue to have a divergence in asset prices going up further, then we will continue to see the K get even longer on each side of the leg. So in that sense, cutting rates is certainly something that normally boosts asset prices and therefore makes the wider K a distinct possibility.
I think you should get very nervous when the Federal Reserve or any central bank for that matter involves itself in a wealth inequality game, because arguably they've exacerbated it for the last 20 years.
And how do they address an economy that's uneven? If they cater to the lower end but end up helping the upper end more, then you have an even bigger problem and you just add fuel to it. It just becomes a real question. Is it a dual mandate? Is it a tri-mandate? Or is it something even more?
I think Chairman Powell has got a divided committee, but he's also been very inconsistent about how he views the labour market this year. And we've talked about this repeatedly. Earlier in the summer, he anchored his view of the labour market around unemployment and then shifted towards payrolls growth. What I just heard from Torsten is you can still anchor it around unemployment. The payrolls growth has shifted lower, but you haven't seen slack increase that much, captured by an unemployment rate that's been pretty steady.
That's why this market is really struggling around the idea that there is no understood reaction function to data that doesn't even exist. So then how do you predict what exactly the Fed is going to do in December? And it's the reason why one person's commentary can swing things one way or another, because there really isn't any type of linchpin to the argument.
Torsten, good to see you. And congratulations on the numbers over at Apollo. Fantastic figures this morning. Tilson, Slok there of Apollo. Coming up next on the programme, Aaron Kennon of Clear Harbor Asset Management, Henrietta Treyz of Veda Partners, Gennadiy Goldberg of TD Securities, and Kylie Cohu of Jefferies. From New York City, this is Bloomberg.
What I see is just a very weird economic cycle. It's an unorthodox recession.
I think the Fed has to be careful here.
The job market is going to be the linchpin here.
There's more two-sided risks to the Fed's decision than the market was pricing in.
This really looks like a slowdown, not a reacceleration.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Here are the scores. We're down 1% on the S&P 500. On the Nasdaq, we're down by 1.3. The pullback continues on the Russell, negative by 1.36. The week ahead shaping up as follows. Some data in the next 24 hours, ISM, ADP, and in the next 12 hours or so, some earnings. AMD, after the closing bell, seemingly this morning, pick your poison. The Palantir narrative, we can get into it. Numbers were pretty decent, but the stock's down on otherwise good news.
What we've seen is a number of companies that have done very well so far this year have been punished even for good results, because ultimately there is a question about how much reality is put into these numbers. The narrative that people are putting around Palantir is they didn't give a good enough guide for 2026. How do you guide a nosebleed moment, which is what the CEO talked about? And that, I think, is the difficulty. How do you guide on technology that's transforming so quickly that people really can't come up with feasible estimates going forward?
Stock is down in the pre-market by 7%. Another name for you this morning is Uber. How's the consumer doing? Uber just posted their strongest growth since late 2023.
And their shares are lower in pre-market trading. And what they're talking about is total gross bookings grew 21%. It's not exactly screaming some sort of recessionary tale for the consumer. People have seen the prices of each ride go up significantly. They're talking about technology and customers and increasing adoption of low-cost offerings and moderating insurance pressures. All these nice words. It's not working in pre-market trading. And I think that that's the tell in terms of just how much the stocks have rallied and how much expectations already were where they delivered.
A lot of people in this country still doing very well. You see that in the numbers that you get from Uber, the financials. Then some other people really, really struggling. And that's been consistent. And you see that in the numbers of the likes of Chipotle that we've seen in the last week, Bramo. That speaks to the politics and election day in America, in this city, here in New York.
What you talk about with Chipotle speaks to New York City politics in a couple of ways. Number one, people are going to be using fast casual. It's not exactly the people who are making millions on Wall Street. It's younger also. They have catered to a younger demographic for Chipotle. And when you take a look at the younger demographic, unemployment rates are much higher. You look at satisfaction rates much lower. They're feeling like they're getting a raw deal. So they're the ones that are struggling to buy $20 burritos, and they're the ones that are going to the polls. And you're seeing that in a strong confluence today.
We'll get to the politics later this hour. Coming up, we'll catch up with Kennon of Clear Harbor Asset Management as rising valuations weigh on Wall Street. Henrietta, Treyz of Veda Partners as the government shutdown ties the longest in history. And Kylie Cohu of Jefferies on how retailers are gearing up for the holiday season. We begin this hour with stocks pulling back from near record highs. Kennon of Clear Harbor Asset Management writing, despite valuation metrics that screen above term averages, we believe the earnings foundation is fundamentally stronger than in prior valuation peaks. Aaron joins us now for more. Aaron, good morning. And good to see you in person, sir. Thanks for being here.
Nice to be here.
Asked this a few times already this morning. How would you describe the pullback early Tuesday, down about 1% on the S&P?
Well, we're due. Pullbacks of 10% or more happen about once every year or so. And we're trading at 23 times forward price to earnings multiple. You look at the market breadth, it's quite weak. Yesterday, the market was up over 1% on the S&P, and the equal weight was off. You look at the equal weighted performance year to date of the S&P 500, it's only up about 8.5%. If you look at the S&P 500, it's up a little over 17.5%. So we have nice earnings growth, but it's being pushed by Mag 7, and it's been quite weak. In the 493 stocks are only growing about 2%, and the rest of the market is growing in the teens.
How would you frame that narrow leadership? Is it a feature or a bug?
Well, I think we've seen a massive amount of sizzle, rightly so, on the CapEx spending front. $400 billion being spent. It's impacting multiple sectors across the economy. And I think there's a question right now as to, how it's going to sort of trickle down in the years ahead.
Credit is very, very robust right now. Is it difficult to construct a bear case for equities when, Lisa, we're getting such limited pushback from credit?
Right now, credit is saying, please keep going. And at a certain point, you can imagine that a lot of the bond borrowing for the tech sector really has only fueled the equity side of things, because they're ultimately borrowing money to pay for some of the expansion. So any pullback, is that just a great buying opportunity, or is there some warning sign about how far you can see the advancement of the tech sector without the rest of the universe catching up?
Yeah, well, I think, as it pertains to credit, you look at, the spending and the debt issuance of late, and I think that's a cost of capital question, just being smart as a CFO of a company, deciding, should you issue debt or should you issue expensive of equity to raise capital to grow. So At the end of the day, we look at the credit side, credit spreads. They're historically extraordinarily tight. High yield is trading at nosebleed tight levels, and we have to be careful about that. So how are we allocating within the credit markets? We're staying very short. If you look at default rates, they tend to collapse inside of about 18 months. And yet we still think you can probably capture the coupon. Atlanta Fed GDP now is running at 4%. The economy going into 2026 looks okay. There's a lot of policy concerns, particularly as it pertains to the upcoming Supreme Court interpretation of the president's authority around tariffs. That could have a massive impact around volatility going forward. But the economic picture looks okay. The K-shaped recovery, on the other hand, is of concern. Lower rates benefiting the 40% of American adults who do not own financial assets. And that's a big issue. It's playing out in the election probably today in New York City.
It's really interesting to me that you saw Mike Wilson and Brian Belsky yesterday on this show talking about a broadening out in the stock market rally. This idea that, yes, Magnificent Seven have done really well, but people are getting worried about frothy valuations. And the idea that the Fed's going to cut rates will only edify some of those other areas. Do you agree with that? Or do you think that it's really too early and people have been trying for this bet for a long time? It feels good because valuations are lower, but it has been a widowmaker.
Yeah, it's a good question, Lisa. I think the idea that as rates trend lower, you can change your discount rate and you can justify higher multiples, ultimately what that narrative speaks to. But I do think that there's the other reality where that 40% that doesn't own financial assets, they do have something. They have credit card debt and they have auto loan debt. If they're lucky, they have mortgage debt, but the first two are not even deductible. And if their incomes are low, they probably can't deduct it anyway. And so lower rates benefit that 40%. And I think that's why there is that divergence in that debate around this issue.
Are you beginning to see credit stress in that cohort that's notable enough to make a more bearish call on the broader market?
It's tricky, Jonathan, because I think we're starting to see default rates rise on the auto loan side. And yet we look at other aspects of the economy, like look at MasterCard and look at Visa and look at the volume numbers there. They're very strong. And now they're talking about strong holiday sales. And so, things haven't fallen apart yet. The employment picture, as Torsten mentioned earlier, is still relatively strong. If that were to weaken, I think that clearly gives a very strong green light for the Fed in December.
So many people are still conditioned by the crisis of 15, 16, 17 years ago, almost 20 years ago now. I'm losing count. And they always believe that risk is just around the corner. Lisa mentioned Mike Wilson of Morgan Stanley. Mike's view of the world right now is actually the recession's behind us. So all this fear that the bad news is ahead of us, Mike Wilson's saying it's behind us. It was spring. That was the low. That was the worst of the jobs data. Move on. We're going to see that recovery. Does that stack up to you?
Yeah, I think there's some truth to that. I think we may see slower growth in 2026. If you look at Bloomberg average estimates, we're going to go from 2.8 this year to 1.8 or 1.9 next year. That may be undershooting. I mean, we could see productivity gains with AI. Does that start feeding through into the economic picture? I think the big question around AI, too, and as it relates to the economy and really your question, because that's still going to drive the economic growth question, is how is AI going to be applied across sectors, across healthcare? How is it going to advance solving for important health issues like cancer and drug discovery, and to accelerate that and add value to the economy and add value to the broader society? And I think that's a big question for 2026 and beyond.
How have you changed your positioning since earnings season really is getting to the latter end? Are you at all, or do you kind of just have greater conviction in how you've been positioned?
Well, I think the idea of just chasing this Mag 7 trade is something that we need to be really careful about. And I think the concept of owning more of an equal weight, or should I say actively selecting holdings in a manner that isn't just taking into account the Mag 7, which has contributed to 61% of the total S&P earnings this year, I think is really an important way to sort of think about it. Last week, we had earnings coming out in many of our portfolios that were very strong. A couple were weak. And the bifurcation of sort of the top line benchmark return relative to, sort of the equal return is I think, a theme that we're going to have to sort of ponder a bit more. And I think selective investments, not just home and abroad. We've been very focused on Japan this year. We've been very focused on Europe this year. And thankfully, we've gotten that right. And sector performance in those areas has been very strong, but very different sector exposures have led to those very positive returns abroad. So we're thinking globally in that regard.
Is there any theme in terms of the companies that are doing very well outside of the Magnificent Seven in terms of either the sectors they cater to, the clientele, or their size?
Well, it's interesting. I think recently we've seen things breaking out. There have been rolling recessions, rolling sector recessions as well. Biotech's breaking out. Healthcare, life sciences. We're starting to see in the earnings calls that China may be normalizing a bit. Look at even the semiconductor design companies that have reported. They're talking about the China business there, which they wanted to exclude from their earnings estimates going forward. Now they're saying they've normalized. It's business as usual. So will that be a theme that continues, and will that drive, sort of beyond the Mag 7 going forward? We'll have to keep our eye out for that.
Aaron, it's good to see you. Let's do it in person again soon. Thanks for being here. Thank you, sir. Aaron Kennon there of Clear Harbor Asset Management. Futures are down this morning by 1% on the S&P. Aaron mentioned the equal weight, down 1%, Bramo, in October. The Nasdaq 100 was higher by almost 5.
Yeah, and this is something that we've continued to see. I mean, I believe that the equal weight has returned about half of what the market cap weight has so far this year because of that dominance of the Magnificent Seven and the K-shaped market, where everything else has really lagged behind.
We've got a pullback so far this morning. That's your price action on the screen. Let's get you an update on stories worldwide. Here's your Bloomberg brief. We start with the former US Vice President Dick Cheney. He's died. Cheney served as the 46th Vice President of the United States from 2001 to 2009 under President George W. Bush. He was also a White House Chief of Staff, Secretary of Defense, and the CEO of Halliburton. Cheney was 84. Elsewhere, the Norwegian cruise shares falling in the pre-market, the company warning of a softer final quarter than expected. 2026 is set to be the 4th consecutive year of record cruise demand, with operators cutting prices to cater to budget-minded travelers. That stock is down by close to 10%. And finally, Yum Brands reporting third quarter earnings that beat estimates, the company launching a strategic review of its struggling Pizza Hut chain and possibly exploring a sale after 7 straight quarters of contraction. The name bouncing back in early trading, we're higher by 1.9%. And that is your Bloomberg brief. Up next on the program, making the final campaign push.
We need a mayor who can stand up to Donald Trump, who can get the funding that New York deserves.
The MAGA movement's embrace of Andrew Cuomo is reflective of Donald Trump's understanding that this would be the best mayor for him.
Kind of odd that in the last 24 hours, almost at the same time that Cuomo's talking about standing up to the president's endorsing him.
I was wondering about how that was going to fly. How does he manage that one? He could say, I can stand up to him because he wants me to be the mayor.
Yeah, with great difficulty. Up next on the program, we'll catch up with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. 2 days of gains on the S&P 500, running into this wall right here. We're down 1% on the S&P. We're pulling back on the Nasdaq. We're down by 1.35. Similar move on the Russell. Under surveillance this morning, let's talk about the politics, making the final campaign push.
We need a mayor who can stand up to Donald Trump, who can get the funding that New York deserves. I can stand up to Trump.
The MAGA movement's embrace of Andrew Cuomo is reflective of Donald Trump's understanding that this would be the best mayor for him. Not the best mayor for New York City, not the best mayor for New Yorkers, but the best mayor for Donald Trump as his administration.
So here's the latest this morning. It's election day here in New York City. President Donald Trump endorsing Andrew Cuomo for the city's next mayor as the former governor faces an uphill battle against the frontrunner, Democratic Socialist Zohran Mamdani. Tracking the story for us here at Bloomberg is Bloomberg's Miles Miller. Miles, good morning to you, sir. Just walk us through how these polls might be tightening up going into the final day of voting.
Right. The last polls we saw were that this was probably a 10-point spread. But when it comes down to it, when you combine the polls with the early voting turnout, you're looking at really the potential of just Mamdani getting to 50%, a 50% margin in this race. If he gets to 50% of the vote when 99% of the votes are counted tonight, that means he has a striking mandate to get past what he has called his progressive agenda. Free buses, we're talking about childcare, universal childcare for those who need it in New York, talking about taxing the rich. All of these proposals really have to get passed by Albany, but he says that he has a partner in Governor Kathy Hochul, a person who has campaigned with him, but he's going up against Andrew Cuomo, someone who people know really well. This is a campaign that has come down to really three big things. Faith, so New Yorkers of faith, whether Jewish or churchgoers, young voters, new voters to the electorate, and also a new majority in this city, right? We're seeing South Asian New Yorkers come out to vote, being a brand new voting bloc with a candidate who reflects them and reflects what they need in this city.
Miles, we played some sound just moments ago of the two leading candidates addressing the sitting president. Miles, is it slightly awkward that the former governor, Mr. Cuomo, is citing his ability to stand up to the president at the same time he's being endorsed by him? And how much of a feature has the sitting president actually been on the campaign trail?
Yeah, I mean, he definitely loomed large, right? He is part of the reason why Eric Adams dropped out of the race, because the president said this needs to be a two-person race. Then you look at Curtis Sliwa, who was pushed not only by the president, but by his boss at WABC Radio to get out of the race. When it comes to Cuomo and the endorsement, Cuomo says it wasn't an endorsement because I didn't speak with him, but it was a tacit endorsement saying if Mamdani gets in office, he will pull funds from New York City. And Cuomo can't walk back from that. But it is important to know, we talk about how Trump has loomed large in the race, that Mamdani has said, if Trump wants to work with me on affordability, that's something he ran for as president, I'll work with him. It's kind of crazy to hear a Democratic socialist saying he'll work with MAGA Donald Trump to make the city more affordable, because that's what Trump has said, right? He wants cheaper grocery prices, and of course he wants for prescription drug costs to go down. So could they work together? Remains to be seen. I think he'll be very ever-present in New York City if Mamdani is to win.
Politics in 2025. Miles Miller, thank you, sir. More from Miles a little bit later this morning and through the afternoon on Bloomberg TV and on Bloomberg Radio. Henrietta Treyz of Veda Partners joins us now for more. Henrietta, something that Lisa and I have been wrestling with throughout this morning. Is this election here in this city taking the temperature of the country, the mood of the country, or just taking the temperature of the Democratic Party? And which argument's going to win out as we head towards the midterms?
You know, it's fascinating. I think you said Donald Trump's name, 15 more times than either of the Democratic candidates in the race today in the lead into here. And I think that just really exemplifies where the Democratic Party is right now. They're so bifurcated and so lacking in a cohesive message that they can really only be anti-Donald Trump. Now, for Democrats, that's a good thing because Donald Trump is a massive vote turnout machine. So for Cuomo, for Mamdani, they're both going to be taking exactly what they want, spreading it out to voters and making it all about Trump, which really speaks to the lack of comprehensive message that Democrats have struggled with since 2016, quite frankly.
That's the reason why I think, Henrietta, a lot of people think of this as sort of like a mini pre-midterms moment, especially given the fact that there are races in New Jersey and in Virginia and California. There's an initiative that people are going to be voting on about redistricting. How much are you going to take a big read-through in terms of what type of mandate President Trump has? What kind of vision gets the most voters for Democrats? How much is this taking the temperature versus idiosyncratic races with a number of very specific inputs?
The off-year elections, this midterm, is one of the best predictors of what will happen in the House of Representatives next November. It is an exceptional early indicator from New Jersey, Virginia, not just who wins, but what the margins are. And the reason that President Trump is so animated about the midterms, if you follow his social media feeds, it's been 48 straight hours of endorsements, is because he is very likely, Republicans are very likely to lose the House, just statistically. with such a tight margin. And that means, massive subpoena power for the House of Representatives next year if it is democratically owned. So it is incumbent upon President Trump to do what I just said he does best, which is turn out the votes, but in favor of the Republican candidates. He really needs to hold on to the House more than anything else. And it's going to be a very serious uphill battle that, statistics and history show he is very likely to lose. So California, Pennsylvania Supreme Court, Virginia, New Jersey, the margins are where wonks like myself will be watching just to see exactly what we should be looking for next year. Is it going to be a 7-seat margin in the House of Representatives, or are we talking like 30 seats? That's what today's election can tell us.
How much are national concerns feeding into the local races, given the fact that the government shut down? There's a lot of dissatisfaction on a national level. At a local level, there is more engagement, an increasing amount of engagement from residents. Is there a divergence here, or is there a pretty clear correlation?
That's a fascinating question. I think it's different for each party. So in this cycle, the Republican Party has continued to be led by Donald Trump. And he's not on the ballot. And so what Republican staff and campaign operatives I speak with will tell you is that Republican voters are tuned out. When we saw the returns on the national election last year, people would go to the polls, vote for Donald Trump, and then leave. So the fact that Trump is not on the ballot this cycle, he's not on the ballot in the midterms, and he won't be next year either. The Republican Party is trying to figure out how can I backfill that dearth and that absence left by Donald Trump himself, the plain leader of the Republican Party, and get our voters excited for J.D. Vance, for Marco Rubio, for any of these local politicians. So you see this depressed participation on the Republican side because Trump is not on the top of the ticket, and that leaves a vacuum for Democrats to turn out. So really it depends on which party you're talking about.
Henrietta, I understand the temptation whenever we cover these stories to group people into very neat groups, Republicans, Democrats, but is there another group, another set of individuals that can't be put into one bucket, that are pretty fluid, and they're willing to vote for someone who's got a solution to their problem? And right now the problem for a lot of people in this country, and it's persisted for a long time, is affordability. And those problems were exacerbated through the Biden administration. They're looking for solutions. It might come from the far left. It might come from the conservative right. Henrietta, I just wonder how much of a feature that's going to be in the elections through the next 12, 18 months.
Yeah, I think it's the biggest feature. You have 68% of the U.S. population that does not support the state of the U.S. economy and is very concerned about inflation and does not support the president's tariffs. So the president and his committee officials and cabinet officials are saying, give us another year. Let us bring prices down. But when voters are looking at their, grocery bill, their electricity bill, the cost of a new car, whatever they're looking at trying to buy, it's all more expensive. It's all because of the tariffs, and they know that. And they are seeing manufacturing. They are seeing grocery prices increase, but not their wages. So the president ran on, theoretically an inflation-related campaign. Inflation was high after COVID, but it remains on the upper rise today as well. And you can see that again at the grocery stores most plainly. So when we go to the polls in November of next year, that's going to be paramount. Are grocery prices high? Is it our number one issue? Or do we care about immigration or crime or healthcare or other tertiary issues? But it's really always the economy. And the president is underwater with the lowest approval ratings that he has ever had in this term or last because of the state of the economy.
Henrietta, thank you. As always, Henrietta Treyz there of Veda Partners with the latest, setting up the politics not just for today, but I think for a generation in this country.
Well, and certainly this has been building for a long time, as you mentioned. This is really dated before the pandemic and then exacerbated by the pandemic and some of the policies during that. A real question here is, we can get into politics, but how much do we end up having cycles that don't adhere to actually creating solutions that are feasible to some of these issues, right? How much is it just promising people handouts versus coming up with constructive solutions that will take time, and it's a very difficult kind of a quagmire?
Unfortunately, we've heard a lot of that in New York City over this campaign. Coming up on the program, Gennadiy Goldberg of TD Securities on the outlook for Fed rate cuts. Plus, Yahara has your morning movers. Uber shares falling on weaker than expected guidance. That stock is down by 4%. Counting it down to the opening about 2 hours away. Equities pulling back by 0.9% on the S&P. We're down by 1.2 on the Nasdaq 100. Pretty defensive posture across assets so far this Tuesday morning. Bonds a bid, yields are lower, down by 3 basis points at the front, through the belly of the curve. Onto 10s, we're down about 2 basis points to 4.087%. Just some risk aversion brewing through the European session continues into the US morning.
Yeah, and ironically, you're actually getting some dollar strength on the heels of it. But what I find interesting is the risk aversion is coming on what? The idea of earnings that are really good, but maybe not as much visibility for next year? Are they coming from the fact that a couple CEOs said that they could see a 10 to 15% pullback in the next 2 years? Well, who doesn't say that, right? I mean, at what point does this just speak to this aversion of where valuations are and an excuse to maybe cash in just a little bit before other people come in and buy?
Should we finish on euro dollar?
Sure.
Just bring up the single currency. It's been such a bizarre year for euro dollar. We've had a break at 115. We're trading at 114.81. I just want to go through the first couple of quarters of the year. So for the first quarter, euro dollar was up by more than 4%. Then we had this additional move of close to 9% in the second quarter. And since then, Lisa, things have really been pretty sideways for the single currency. If anything, there's been a bias to sell it. So much of this year was defined. So much of the narrative around foreign exchange was defined by the first quarter and early into the second quarter for foreign exchange. And since then, that sell the US, sell dollar trade has lost a lot of steam.
Yeah, and a lot of the enthusiasm for all of the infrastructure spending in Germany has also lost some of its steam in terms of how much it can really edify the entire region. You've seen the weakness of Germany and France relative to Portugal and Italy and Spain and some of the other countries that are in the southern parts of Europe. So it raises a question, how much is this euro weakness and how much is this dollar strength? Right now, the Bloomberg Dollar Index is currently at its highest going back to May. So really, we're tracing a lot of the weakening that we had been seeing.
Euro dollar this morning, 114.81. As we count you down to the opening bell, let's get you some single names, some morning movers. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. We start with Uber. Those shares are down nearly 4% in the pre-market, despite the company posting its strongest growth since 2023. Gross bookings jumped 21%, easily beating estimates, and trips soared both here in the U.S. and internationally. So why the dip? Well, the stock had jumped some 60% so far this year. Plus, Uber did highlight some legal costs that did cause a dent to profits. Meanwhile, turning to travel, we are seeing Norwegian Cruise Line holding shares down nearly 9% after the company warned that the final quarter of the year will be softer than expected. Plus, its yield growth, which is the amount of money they make from each passenger, will also be softer than expected. So some of that consumer strain showing up in these results. And we end on shares of Spotify. Those are in the green. They are up nearly 5% after posting a solid quarter. Monthly active users rose by more than expected, while revenue topped forecasts thanks to some price hikes it implemented this year. This comes as Spotify expands further into podcasts and video. It struck a deal with Netflix that will bring some of its podcasts exclusively to Netflix, but not Joe Rogan. John?
Yahara, important final point. Thank you. Spotify up by about 5%. On a radar this morning, US voters heading to polls across the country. Key races in New York City, New Jersey, and Virginia. The first major elections since President Donald Trump's victory last November. Where has 12 months gone? Just absolutely bizarre. Elsewhere, Norway's sovereign wealth fund will be voting against Tesla's proposed $1 trillion pay package for CEO Elon Musk, highlighting concern over its size and the, quote, lack of mitigation of key person risk. And finally, what are 24 hours? Alphabet selling $17.5 billion of bonds in the US after tapping Europe's debt market for 6.5 billion euros. The firm joining the likes of Oracle and Meta in utilizing multi-billion-dollar debt sales to finance AI investments.
This has been a story that we've been talking about throughout the year, and it's not just the big tech giants. And I think this is important to mention. It's easy to say, well, they're making so much cash that at a certain point you can understand why bondholders or bond buyers are thinking, okay, we can accept this risk. At the same time, it's not just them. It's a tsunami of other related tech issuance that's coming on the heels of them, of companies that might be more speculative. So here is the question. Is it really these companies that are the risk, or this proliferation of the AI trade? You say AI 3 times, everybody wants to buy your debt. And that, I think, is what a lot of people are examining with the cockroaches and the cracks and the 10 to 15% drawdown and all of the other rhetoric that we're hearing from CEOs.
One counterpoint, just one. And I'm going to use some of the things that you've often said, and Peter Cheer has as well. The risk is where the perceived safety is, right? And people always talk about the strength of the balance sheets of these particular companies as being the ultimate bastion of safety. That's why they trade within around 1 percentage point above treasuries, like the issuance we saw yesterday. So is this the one to track? and not the other stuff.
It's a great point, the idea that the greatest risk is always in the debt that's perceived as the safest. A question, though, for that isn't necessarily whether these companies are going to go belly up or whether that you're going to get a repeat of the telecom industry where all of a sudden AT&T bonds were trading at a very high level and then suddenly they sank dramatically because ultimately they didn't have the same kind of profit expectations going forward that they did in the past, and then all of a sudden they were downgraded with the debt and the sustainability there. So you're right, but that's not necessarily an overall bubble that's going to bust, that's going to create this total credit crisis, as much as you might lose your money, lose some money.
These companies right now are making a ton of money. And at the moment, just for an observation, there's no pushback coming from credit at all. The order book was absolutely massive yesterday. And that's the thing I'd be looking for. This is great for equity investors because this is going to be funded by the credit market. So maybe that's another feather in the bullish cap this morning. But for credit, I don't see the pushback. Do you?
I don't see any pushback. In fact, Meta's book was completely oversubscribed, something like $100 billion of offers for their $30 billion bond offering. I go back to what Bob Michael of JPMorgan Asset Management said, which is there is just so much money chasing yield, so much cash that is sloshing around from the pandemic, all the stimulus checks, all of the additional rounds of payments that are looking for something to earn some income. And that might be the biggest problem for some people because ultimately it keeps going into some of these instruments and you're going to reward behavior you might not like, but what is your other option?
This story's changed for the tech players. They used to issue a lot of debt, and it was to fund capital return programs, buybacks, because they didn't want to bring the money home from abroad. That's a different kind of issuance. This is CapEx, and we talked about it yesterday. People like these companies, and they came on this program for years because they were asset light and capital return heavy. That's not what these companies are going to be several years from now, based on the communication we've had from the likes of Meta in the last week.
These are going to be property owners, data center owners, energy plant owners. These are going to be building out huge infrastructure, making big bets because it is an existential threat not to. And so this is going to be increasingly a faith-based story where we all have faith in a future that looks similar to what we are extrapolating from right now, but where a lot can change.
Alphabet down this morning by close to 2%. The broader market not doing well. A lot of that driven by some of the major tech names that helped get us here. Equity futures down by about 1% on the S&P. Let's stay on the market and turn to bonds. The US 10-year yield ticking up following the Fed's October rate decision. Gennadiy Goldberg of TD Securities says lock in the yield. Writing, we expect 10-year bond yields to reach 390 by year-end, 350 by the end of 2026. Gennadiy joins us now for more. Good morning, sir.
Thanks for having me.
Why the bullish view? That glide path down to 350?
Well, a couple of things. One is we do expect the economy to moderate as we head into next year. So gradual moderation, not anything crazy, not a recession necessarily, but significant risks to both upside and downside, and we're leaning a little bit more towards the downside. Second is that wall of cash. And third, and I think this is a key point that's missed by a lot, is the Fed was a net seller, effectively, of treasuries all of the last couple of years. Starting next year, they're going to become a net buyer, whether it's through reinvesting MBS into treasury bills or doing reserve management purchases, which we now expect in the middle of 2026. They're going to be buying, call it $300 to $400 billion of treasury bills over the next couple of years each year. That's a huge bullish tailwind to the market where the treasury is already issuing at the front end.
Not QE or QE?
It's going to look, walk, talk, and quack like QE, but it's not QE, right? It is reserve management purchases. They will explain it. They will keep explaining it, unfortunately. But what we know is that it's only to keep the balance sheet at a constant portion to either bank assets or GDP, and it's to prevent a repo crunch. We are seeing some pressures at the very front end, so that could get pulled forward. Right now, our expectation is mid-2026 for those purchases. There is a risk that as we head into year-end, we might actually see some significant repo pressures, and they might be forced to pull that forward even more.
So how much is your bullish call an argument about the U.S. economy, and how much is it a bet in the 2026 Fed that has an inclination to suppress yields in whichever way?
A little bit of both. I mean, honestly, you've got the Fed quite significantly looking to cut rates. I would say, we do expect one more cut in December. So despite Powell pouring cold water on December, I still think it's a go. Next year, we expect them to switch to more quarterly cadence. So going once in March, June, and September to reach 3% terminal. And part of that's going to be driven by uncertainty on the economy. So if you've got an uncertain economy, you continue to gradually moderate policy until you get to somewhere closer to neutral, right? They don't want to over-tighten. And that's going to drive yields a little bit lower. And the closer you get there, the more likely you are for the market to kind of branch out their probability tree that more cuts could potentially be coming. So that's part of that.
I guess I'm struggling with this idea that some people are talking about caution in the economy, and other people, from Torsten, Slok to Henrietta, are talking about inflationary pressures and the fact that the economy is doing just fine. So how do you square these ideas that early next year we're going to get the stimulus coming from some of the tax plans from President Trump, the rebates that people are expecting to get? You could get a reacceleration from more confidence around the tariff regime. You could get a lot more uncertainty. But this whole idea of a sense of reacceleration into next year, why do you push back so hard against that?
So it's going to be a fat tails type of year, right? Our base case is, whether mine or some of the other folks you were talking about, I think our base cases are fairly similar. The economy is doing okay. We think there's going to be some pressure at the very, lower tier of the consumer breakdown. Those are going to be folks, yes, they will get tax rebates, they will get more kind of relief in that sense, but we don't see enough for a full-blown reacceleration. You've got a labor market that's quite weak. You've got companies that are taking on some of this margin pressure, and it is feeding through into their margin. So look at where the inflation's coming from, right? It's going to be coming from pass-through, from goods prices. The question is it going to come from services? We think not. There are folks who think it'll be, just like COVID, where you'll get that contagion, basically, into the services sector. We don't think so. We think it'll come from goods. It'll pass through. The Fed will kind of look past it, kind of like Governor Waller's been saying, right? It's a one-time deal, this time for real, right? This time it is really transitory. But once we get through that, we should be easing to kind of take care of the softer labor market, because it is actually slowing down a little bit.
Governor Waller's not the Fed chair yet. Might be in the future. A lot of people come on this program say he should be. He's not the Fed chair. Does the heart of the committee, based on what you can see at the moment and hear, are they willing to look through that inflation hit?
I think so. I think they're cautious, right? No one's really pounding the table except for Governor Waller, and I think part of that is to potentially become Fed chair. But I do think that most of the kind of the core of the committee sees neutral at around 3%, not 3.75 or 4%. I think what you're hearing now is a little bit of a mixed message, because we're reaching into kind of the upper tiers of where folks expect neutral to be. Look at the hawks. Look at the 4 hawks who've spoken since the FOMC meeting last week. All of them see neutral at around 3.50 to 4%. We're scratching into their territory. So they're saying, look, we're done. We're neutral. If you look at Powell, Waller, and some of the other core FOMC members, they're all thinking a heck of a lot lower from here. I mean, low 3s, not high 3s is what they're thinking. So there's a lot more room for cuts. All they need is just that data, right? Which we've unfortunately been lacking, to tell them that they should continue to cut rates.
How dovish do you think this committee is going to be in 26? Given the vote mix, the change, the new votes that we get on the committee, plus the new leadership in May and beyond. Just how much strength is that dove, that uber dove in Chairman Powell's seat, actually going to have?
I think it's moderately dovish, right? Like we're expecting 3% simply because there is going to be that split. There will still be hawks on the committee. I mean, you'll have Lori Logan, you'll have Beth Hammack, both voters next year. And they'll be replacing a couple of hawks who are voting this year. So at the end of the day, you're going to have a lot of disparate voices. It's going to be, I hate to say it, data dependency. We'll have to decide. The problem with, government shutdown is you kind of have to do it on vibes and not on data. And the problem is the Fed is not very comfortable doing that.
Beth Hammack is just itching to dissent, right? You just get that feeling in every speech we get. Itching to dissent.
She just keeps reiterating the inflation concerns. And honestly, there is an argument to be made, Jeff Schmidt really also leaning into this, the idea that inflation has remained above 2% for more than 5 years. It starts to raise some concerns at a time when everybody disagrees in the labor market, considering the fact 5 people in a room, you get 25 views in the labor market.
We've got no data, at least not the official data anyway. Gennadiy, it's always good to see you. Thank you, sir. Gennadiy Goldberg there of TD Securities. If you are just joining us, welcome. Equity futures down all morning. We're down about 1% on the S&P 500. Some price action still searching for a narrative. We'll have more guests to weigh in and tell you why they think we're down this morning on the S&P and elsewhere. Let's get you an update on stories elsewhere. Here's your Bloomberg brief. Secretary of State Marco Rubio reportedly helping persuade President Donald Trump to leave NVIDIA chips out of last week's talks with China. The Wall Street Journal reporting that Rubio warns selling top-tier chips to China could pose a national security risk. Elsewhere, shares of iHeartMedia are surging in the pre-market. Sources telling us here at Bloomberg that Netflix is in talks to license video podcasts distributed by iHeart. Netflix is reportedly seeking exclusivity for the programs. That stock is up by almost 14%. And finally, Starbucks is selling a majority stake in its China unit to private equity firm Boyu Capital for $4 billion. Boyu will take up to 60% of Starbucks China retail operations through a joint venture. That's the latest in our Bloomberg brief. Up next, last-minute orders.
companies have mitigated for the cost impact. What we have seen is that retailers have postponed their decision in making orders to the very back end of the year.
A conversation up next with Kylie Cohu of Jefferies from New York City. You're watching Bloomberg TV. Live from New York City, welcome back to the program. Here are the scores so far this Tuesday morning. Equity futures negative by 1%, on the Nasdaq down by 1.3, on the Russell down by 1.25. In the bond market, a bid into treasuries, yields down across the curve, 2s out to 30s, 10s down by 2 to 4.09%, down by 2 at the front end of the curve as well, 357.79. Some pushback from some Fed hawks in yesterday's session. I think also, Lisa, coupled with the fact that we've had a ton of issuance on the credit side, and typically that kicks things around for treasuries as well.
You have heard from Lisa Cook, the first time that she's really spoken publicly. There have been some other officials that have come out and talked about the inflation risk. At the same time, that's been ongoing, right? We knew that this was the case, that there was a very split committee, that the supply, though, is a big deal. The idea that you suddenly have $30 billion, $17.5 billion flooding the market. You have to think there's some competition from the tech sector.
Politics is well in focus today. It's election day in America. Can you believe it's been 12 months since the election?
I mean, it feels both like 10 years.
Where is the 12 months gone?
It's been on a hamster wheel that we're all trying to catch up with to try to understand what's going on.
Those of you that know me know that I like to put the Christmas tree up early, like really, really early, first week in November early. But this time around, first week in November feels very, very early. I can't believe we're almost there.
So what's really early for you? December 1st?
Typically, I like the first week in November. We're maybe going to push it to like middle of November. Next weekend after that.
True side.
I don't wait for Thanksgiving.
That's just.
I like to have the decorations up at Thanksgiving.
I get it. It's beautiful. Right? It's warm. It's festive, especially with the cold air. I get it. It's lovely.
Precisely. Let's talk about holiday shopping. And the surveillance this morning. Last-minute orders.
What we're seeing is that companies have mitigated for the cost impact. Consumer demand for toys is growing, has been growing every quarter in the U.S. and overseas. What we have seen is that retailers have postponed their decision in making orders to the very back end of the year. But seeing that there is demand, there is consumer demand, people are buying product at retailers, we expect to see a good holiday season.
So here's the latest this morning. Companies and consumers dealing with tariffs and now the government shutdown ahead of the holiday shopping season. Kylie Cohu, a consumer equity research analyst at Jefferies, writing, the prolonged government shutdown appears to have been the primary catalyst driving consumer sentiment to a new post-election low. Kylie joins us now for more. Kylie, good morning.
Good morning. Thank you for having me.
Thank you for being here. Just frame the state of play for retail America going into year end.
Well, it's a big question mark, right? So what we're seeing is the consumer seems bifurcated overall. We have the lower income consumer who's clearly being hurt, and the recent SNAP benefits that may or may not be coming is a big question mark. Then you have the higher income customers. They seem to be doing pretty well, but the question is, how much are they going to spend on some of these goods that are really increasing in price due to tariffs as we head into the holiday season?
You heard the Mattel CEO. He's trying to work out whether people are going to buy and stock the shelves. Is that going to happen?
Well, right now the shelves in the toy aisles themselves look pretty well stocked. I wouldn't say that they're overflowing like we saw last year, so that is going to be a headwind to toy sales that we've seen in Q3. Now the question is this demand going to show up in Q4? And then will that flow through to the toy companies closer to the actual holiday?
It's surprising how little visibility even the CEOs have about just how much people are going to turn out and how much pricing power they have. What's the strategy that you're hearing from chief executive officers in terms of how much they're increasing prices, how much they expect consumers to absorb some of the tariff increases versus just accepting margin pressure?
Yeah, so overall what we're seeing is everyone's eating a little bit of the tariff, right? So you're seeing that both with the toy companies, you're seeing that with their suppliers, you might even see it with some of the retailers, and then ultimately what's left over is being passed on to the customer. How they're doing that, a lot of them are describing it as very surgical, right? So it's these items that are going to be the hottest toys with the latest releases, things like that, while keeping these core items under that sweet $20 price point.
So in other words, if you have popularity, use it and you're going to be paying $2,500 for something, and then otherwise things will be discounted. Are there companies that are doing a better job of that than others, right? I mean, is this sort of a tale of two consumer retail companies, or is this pretty broad-based? Is this sort of the accepted practice?
Unfortunately, it's pretty broad-based. So we like both Mattel and Hasbro heading into the holiday season for different-ish reasons, right? Hasbro has that adult consumer that continues to buy, continuing to show up. Mattel, we really like the actual products, the Wicked dolls, the Jurassic Worlds, things like that. They're going to resonate well with the kids themselves. So overall, we like it. It's just a matter of, again, are these people going to buy into this holiday?
What are you learning from other industries? Do you follow the restaurant business, for instance? We've been talking about Chipotle loads and trying to figure out if that's a Chipotle problem or a broader issue with the economy. They've cited a younger demographic who aren't spending as much. Anyone who earns under $100K a year is struggling in this country based on their communication. Do you see that as a single issue at a single company, or are you seeing that across the companies you cover too?
I mean, really, we're seeing it across consumer, right? So just about any consumer, whether it is the really low end, the mid, or the high end, no matter what, we're seeing them become more choiceful. Now, how choiceful they're becoming really kind of does depend on that, all those kind of buckets, right? But no, unfortunately, we're having to trade out of, eating out, and then you're going to trade into eating at home. Same thing with kind of how the holiday shows up. People are going to buy toys for their kids. That's not necessarily the question. The question is, what are they going to buy and at what price points?
Fed's tracking the same thing. What is the consumer price tolerance right now? Which is why the governor Meera into this world are more concerned about labour than they are inflation, because they don't think you can pass this on in quite the same way as we saw coming out of the pandemic.
Yeah, and really, it's sort of frustrating because we're looking for the answer, right? Is the consumer strong or is it weak? Are we going to see that sort of a real clarity moment in this December when we have people going out and spending and accepting the price increases or not? And it's the same nuanced story that is so unsatisfying. I'm sorry, I don't mean to be complaining about this, but Kylie illustrated it. They're doing it on the margins. They're being surgical. They're being smart about it. So there are price increases here, but not necessarily here. And some consumers are being choiceful. And it's not a story you could really be satisfied with because it doesn't give you a sense of what the policy mix really should be going forward. I am sorry for the rant, but it feels like this is going to be the ongoing story.
Kylie enjoyed it. Lisa did it on your behalf.
Yes.
You agree, right? I mean, how do you have any conviction on anything?
Exactly. And I think that is the big question mark, right? I keep kind of saying that, but, I keep telling my clients, I'm like, well, what are you seeing in the consumer? And then let's kind of build a framework from there. What we're seeing in the consumer is, yes, there is confusion. And to the point at the top of the segment here, is this just the government shutdown? Are people just confused about that? And could this clear up in the next week? I don't know.
Kylie, I've got no idea how long the government shutdown goes on for. Might go beyond the next week. Kylie, thank you. It's good to see you. Kylie Cohu there of Jefferies on retailers in America. Up next, we'll catch up with Meera Pandit of JPMorgan Asset Management, Kathy Bostjancic of Nationwide, alongside Bloomberg's Mandeep Singh and Michael Ball. From New York City this morning, good morning. The third hour of Bloomberg Surveillance up next.
The AI story is so dominant right now.
The market is punishing anybody who decides not to play in AI.
AI is going to be a defining trend probably for the next 5, 10, 20 years.
You have to own a little bit of everything, not just tech. Earnings growth is going to be better next year than people expect. Right now, I think it's, we're in pretty good position.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Pulling back from close to all-time highs on the S&P 500. We're down across the board, down by 1% on the S&P, negative by 1.4 on the NASDAQ. In the bond market, a rally. Yields are down across the curve. On a 2-year, we're down by 3. On a 10-year, we're down by close to 2, 4.09%. Going into all of this in the week ahead. Lots of economic data. ADP, ISM services, a sprinkle of earnings with AMD just around the corner as well. And we should not forget, it is election day here in New York City and beyond, Virginia and New Jersey.
Yeah, possibly a national referendum or possibly just local issues that are coming to the fore. A real question here for New York City for the fight for the Democratic Party, although ironically it's a fight between a socialist Democrat and an independent. But nonetheless, there is a real question here about whether this is representative of a larger question. I do think it will be very interesting in this mini midterm to see how much President Trump looms large and how much it's a referendum on some of the recent policies and whether that really plays into reopening the government or any of the potential policies.
Certainly loomed large yesterday, didn't it?
He did.
Wasn't that strange? Governor Cuomo, former Governor Cuomo, talking about standing up to the president and then the president coming out and endorsing him.
I mean, thank you, but at a certain point, you have to wonder whether it was a welcome endorsement, right? Because it gave Zoran Mamdani an easy way of saying, well, of course he wants him to win. He's going to be the one that's better for his policies. And then, of course, Andrew Cuomo is saying, well, we're going to at least be able to stand up to him because he wants us to be there and then he'll give us funding. I mean, it's very awkward. This really highlights how awkward it is for President Trump to be involved in this at a time where it is the key reason the Democrats have to have any unity whatsoever. Other than that, what do they have? And I think that's been one of the challenges. What is the more proactive message versus just, we're not Trump?
That's the politics for New York City and beyond, and we'll have more on the beyond later on this hour. Need to talk about this market too. Palantir came out with earnings after the closing bell. Earnings were okay. Stocks down on otherwise pretty decent news. Taking a broader market with it, we've had complaints, pushback from certain CEOs on Wall Street as well. We heard from Morgan Stanley, from Goldman Sachs, from others too. Really pointing out the obvious. The valuations are stretched, valuations are full, the rally's sort of long in the tooth, and we've heard this a million times from a million different people.
And the Palantir earnings really highlight just how much these worries are coming to fruition. Give your narrative whatever you want for today's blip. But the fact that these shares are up 150% so far this year is the reason why they're down 7.5% right now after reporting earnings, the 21st consecutive beat, and going out and talking about Alex Karp, the CEO, saying we are in a nosebleed zone. No one else is here. Everyone coming out and saying, this is amazing. You have a company that's $4 billion in revenues and they are posting 63% growth. Oh, my goodness. This is a moonshot. And yet the shares are down because they didn't give enough guidance about how much of a moonshot it was going to be next year. This just highlights people are getting nervous. They're taking some chips off the table. I don't know how much we can extrapolate out beyond
Let's
this.
take a step back. How difficult is it to construct a super bearish argument right now, given the limited pushback that we're seeing in places like corporate credit? When these companies come out and issue the kind of debt they have, Meta last week, Alphabet in the last 24 hours, and the order book is loaded up to the extent that it was. How difficult is it to sit here and say, yeah, we're on the precipice of something really bad happening with the credit market just sucking it all up right now?
Very difficult, which is why every dip has been bought. I think the bigger question is, will there be a deep seek moment where some of the big build out in infrastructure gets called into question, akin to back in the 1950s when computers came out and there was an entire room the size of this room that was needed to house a computer, and now we have it on our phones. So this is sort of some of the discussion, but we're not there yet. The demand is just still so outpacing supply.
At these levels, I get it. Our capacity to absorb bad news is somewhat limited. We've pulled back by about 1% on the S&P 500. Coming up this hour, we'll be catching up with Mandeep Singh of Bloomberg Intelligence. As AI bubble concerns continue to grow, we'll speak to Meera Pandit of JPMorgan Asset Management, with stocks pulling back from all-time highs, and Kathy Bostjancic of Nationwide as traders turn to private data for rate cut clarity. We begin this hour with stocks falling as Palantir's earnings, despite an increased revenue outlook, failed to meet Wall Street's lofty expectations, fueling concerns that the stock might be overvalued. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, welcome to the program, sir. Stock is down and down hard. Is that validated? Is that move justified by the numbers you heard yesterday?
I mean, look, it was a nice beat and raise quarter, but right now I would compare Palantir to someone like OpenAI, which is also valued at, $500 billion in market cap in private market. And when I look at the growth trajectory of OpenAI, I mean, look, that company is almost, 13 billion plus in ARR. Palantir is more like 4 to 5 billion in revenue. So from that perspective, why is OpenAI not valued higher than Palantir? And that question comes up. Even though Palantir's growth is stellar and the quarter was great, but it's just not growing as fast as an OpenAI or Anthropic is. And so that's why I think you're seeing this kind of a stock reaction this morning.
Mandeep, we were just speaking moments ago. Lisa was talking about it, the lack of pushback in credit. We have had a little bit of pushback in equity in the past week. We saw that with Meta. We've seen it again with Palantir. Is there a broader story beginning to build in the equity market?
Well, I think the ROI question is getting asked more and more. And so what this earnings showed us was the hyperscalers that were not showing clear ROI, notably Meta. I think that's where you saw a negative stock reaction. The other ones, Alphabet, Amazon, Microsoft. Microsoft, I think, was more of kind of a reflection of the whole OpenAI situation right now. But overall, I think the hyperscalers with public cloud revenue did get rewarded in terms of positive stock reaction. So to my mind, the ROI question is front and center, and companies that are showing ROI and valuation is not stretched, you are still seeing upside to estimates and valuation.
Mandeep, thank you, sir. Mandeep Singh there of Bloomberg Intelligence. Palantir down in the pre-market by about 7%. For the broader market, Meera Pandit at JPMorgan Asset Management writes the following. AI is not a bubble. It's not a boom. It's a boom and bust. Tech drives sweeping secular trends and structural change, but it's also inherently cyclical. Meera joins us now for more. Meera, good morning.
Good morning.
Where are we in that so-called cycle?
I think we're sort of mid-cycle still. We've seen some of the heady increase from 2023 and 2024 in terms of the build up to this technology. But what we should remember is when we see any sort of innovation, yes, it can lead to a secular bull market within that theme, but there's going to be some fits and starts. We saw in January pullback. We saw in April a pullback there. If we looked back to 2022 before a lot of this AI really took off, even within the Mag 7, you saw the maximum drawdown that year in that cohort of companies of about 43%. So investors should still expect that there can be some volatility within this theme, even if the overall trend is to move higher. Because these are cyclical assets, as you guys have talked about here, we've moved from a very capital light industry to something more capital heavy. And there is a chip cycle. There is a CapEx cycle. I do think that these companies will be subject to the ebbs and flows of those types of cycles over the arc of time.
How do you understand when we're reaching the limits of valuation? Because that's ultimately what the market seems to be questioning this morning.
It's a question that's not only around the AI stocks, it's for the broader market, and we do find some justification for the higher valuations that we're seeing. But ultimately, when you look at the bull case for some of these AI stocks, you're still seeing that revenue production. You're still seeing that overall leverage is low. Yes, some of these companies are increasingly tapping the bond markets, but that is smart capital allocation. When you think about if you were a home buyer, you may not buy your house in all cash, even if you had the wherewithal to do so. That financing still does make sense in this environment. You think about the demand that is there and the demand that is being monetized. So I do think that you're getting what you're paying for at this stage. It's just important to watch how does adoption evolve in some of these AI applications. Are people paying for them? Are people using them to make poems and memes? Or are they actually using them for business purposes and enterprise purposes? Again, are they being paid? Are they being used in the right way? Are they gaining that traction? Is there any drop off in adoption? Because some of these companies may be very cash rich, but not all of their buyers are. We have to think about the power limitations. We have to think about that circularity of deals. Is this a game of dominoes where if somebody falls down, everybody else does? Or is it a game of musical chairs where if somebody doesn't get the chair, everybody else is still okay? So a lot of considerations within this theme, but overall, we still do feel confident at the stage we're in coming out of earnings season where we've seen what we've seen from some of these companies.
To be fair, some people think that poems and memes are work, and that actually could be the way that we all put our analyst notes out in our discussions.
Using AI for poems? What's going on here? Where's this
Roses
come
are
from?
red, violets are blue.
Oh, it's that kind of thing.
Yeah,
Oh,
we're
okay.
so happy. We hope you are too. I'm just curious.
Sorry, I've cut in. All right.
No, but I agree. I mean, I don't know that anyone's using it for their poetry, although I do know that my oldest son is in a poetry class, so I can't promise that he is not using it for his poetry. I am curious, though, at what point do you see warning signs versus doubling down and seeing a sell-off and saying, okay, I need to buy more?
I think the market reaction right now is actually reasonably healthy because when you think about the earnings that were produced, they were still overall pretty good across the board. And you actually continuously over the last 3 quarters have seen earnings surprises for the Mag 7 as a cohort above 10%. So very elevated levels of surprise. And yet the market is still being somewhat punishing where the guidance doesn't look as strong as it could. So you do see that the market, while it continues to rise and it continues to rally around AI, increasingly where the investment is going from the average investor is actually to some of the broader AI themes. It's not just the AI innovators, it's the enablers. When we think about things like industrials and utilities, look at some of the growth rates this quarter in terms of earnings on utilities, which used to be a pretty sleepy sector, but you're seeing 20% growth rate in earnings in that sector. So you're seeing that broadening out. Again, I think that the area that we'd watch for most is, can you get to the AI adopters? And what are people willing to pay? Are they adopting at increasing rates? That is the question mark. And I think that's where some of the broader concerns that may not be within the AI companies could extend out. And it maybe won't be a credit issue, but if we do see a slower economy at some point and people are pulling back on what they're planning to spend on their AI, then that could be a sign that things have been overbuilt for a time period. Again, these are cyclical. You can see a downswing. You can also potentially see an upswing. But right now, when we look at that earnings contribution from the Mag 7 that have reported so far, they make up 4 of the strongest upside contributors from a company perspective, but also one of the weakest. So that bifurcation, I do think, is a healthy sign that investors are responding accordingly.
It sounds like at the moment you've got a lot of the clarity that you need, even without the official economic data. Are there any blind spots for you at the moment?
Certainly, we would like to see what that economic data is showing, because as I think it relates to the rates picture, there's a lot of question marks. I don't know that the rates picture flows in as neatly into the AI story, because it is pretty rate insensitive given how some of that is being financed. But if you then move over to the macro picture and you think about the Fed and how they're making decisions, this tug of war that we're still in between hotter inflation, weaker jobs is a huge outstanding question. And you could say, well, maybe the data is not showing anything new underneath the surface, but that wasn't the case this summer, where we saw meaningfully weaker demand for labor and didn't really see it coming. Or it was also not the case with inflation, where we expected to see more of a bigger pickup from tariffs, and yet you've seen core goods in a reasonable spot, maybe some hot spots like apparel, but overall not a huge pass-through effect. So I think understanding on the margin where some of those issues are would be incredibly helpful for us as investors as we think about the rate environment.
That debate's not going to be resolved by year end because we don't have the economic data. And based on the division at the Federal Reserve, I'm not sure that 2 payrolls reports, even if we get them, are going to change many people's minds.
Yeah, the problem is it's not just that we don't have data. We don't have a reaction function. Right now, can anyone describe what exactly this Fed committee is looking at that will determine what exactly will make the difference between a rate cut and not? And I don't think anyone has a good answer.
They're all looking at different things at the moment. Meera, you're going to stick with us, I'm pleased to say. Meera Pandit at JPMorgan Asset Management. If you're just joining us, welcome back to the programme. Equity futures at the moment on the S&P 500 negative. We're down by about 1%. That's the price action. Let's get you an update on stories worldwide. Here's your Bloomberg brief. We start with the government shutdown in its 35th day. One area that's been hard hit, air travel. According to trade group Airlines for America, more than 3 million passengers have faced cancellations and delays related to staffing since the shutdown started. Elsewhere, Spotify shares rising in the pre-market. The company reporting monthly active users grew 11% year over year in the third quarter. Spotify's 713 million active users and 7% revenue increase beat analyst expectations. That stock is up by close to 6%. And finally, shares of Uber falling in early trading. The ride-sharing gap posting its strongest quarterly growth since late 23, while also delivering a beat on gross bookings. Uber also announcing it will change how the company reports profitability starting next year. That stock is down by 4.5%. Up next on the programme, the Morning Calls, plus an update on the race for New Jersey governor as Election Day heats up. That conversation just around the corner.
Of course, it is likely there'll be, a 10 to 20% drawdown in equity markets sometime in the next 12 to 24 months.
On the near-term valuation side, there's some challenges.
We should also welcome the possibility that there would be drawdowns, 10 to 15% drawdowns that are not driven by some sort of macro cliff effect.
Can we call this pushback, or just sort of stating the obvious that you get a 10 to 20% drawdown sometimes?
I'm actually laughing because I'm thinking people are using that discussion as justification for what we're seeing this morning.
Yeah, no.
Yeah, thank you. I think that sums it up.
I'm right there with you. I'm struggling with it too. Here's the price action, and we've said all morning, price action struggling for a narrative so far. We're down about 1% on the S&P 500. On the Nasdaq 100, down by 1.4. Similar move on the Russell. We're down by 1.3. That's the price action into the opening bell. Let's get you some morning calls with one stock in focus, Palantir. First up, Bank of America raising its price target on the stock to $255, saying it has, quote, a winning differentiated formula. Elsewhere, Mizuho raising its price target on Palantir to $205, expecting it to benefit from long-term AI trends. And finally, Jefferies also raising its price target, citing strong fundamentals, but seeing an unfavourable risk-reward. So we've got a stock that's down hard in the pre-market, and the analysts are basically boosting their price targets on the stock.
Because ultimately what Alex Karp talked about was this nosebleed moment and the fact that you're seeing really rapid growth. So either people don't want to bet against it because it's career risk, or there is some sort of dissonance with concern about valuations where they are versus the analysis community that sees a real upside.
Stock is down by 6 to 7% through most of this morning. Broader market at the index level on the S&P 500 negative by about 1%. Let's turn back to the politics and the elections. The New Jersey gubernatorial race between Democratic Representative Mickey Sherrill and Republican Mike Ciattarelli is tightening. Bloomberg's Romain Bostic, charged with following the story throughout this morning and into the afternoon, joins us now from New Jersey. Romain, what's at stake in New Jersey today?
What's at stake is really a referendum to a certain extent on the national political climate. John, here in the United States, election cycles are every 4 and 2 years. These off-year election cycles, like the one we're in right now, typically aren't all that notable. But this one's different. We're 1 year removed from one of the most controversial U.S. elections in history and 1 year ahead of what could be even a more controversial midterm election. And that puts a governor's race like the one here in New Jersey highly in focus. Jack Ciattarelli, he's a Republican candidate. He's run twice before and lost, but each time he's picked up ground here, and so too have Republicans. Remember, this is a heavily Democratic state, at least in terms of the way it votes, John, but not necessarily in terms of the actual registered voters. This is a state where independents outnumber Republicans by a significant margin and pretty much keep sway with Democrats on pace, about 38% to 35%. And those folks are the ones that are going to decide this elections. Those are the folks that Jack Ciattarelli has been courting, and so too has Mikey Sherrill. And now Sherrill's lead, a commanding lead that she had just a few weeks ago, 10 plus percentage points, that is now narrowed considerably. The most recent polls, John, now showing that she has a lead in some cases of as little as 3 to 5 percentage points.
Remain 12 months since the national general election, and you helped lead our coverage, our swing state coverage, just 12 months ago. Do you get the sense that this race in New Jersey actually takes the temperature of the mood of this country, or is it specific to this state?
A little bit of both, John. It's hard to say. When you talk to people here, they say that, yes, this is basically a centrist state, and maybe it will give us a little bit of a sense as to whether this nation will continue to move to the right or maybe swing a little bit back towards the center. The president of the United States, Donald Trump, and his surrogates, they seem to feel that they can actually turn what has been a blue state for at least the last 3 to 4 decades into a red state. Remember, John, in the last election, Trump really narrowed his support here in this state. He lost to Biden 4 years ago by 16 percentage points. He only lost to Harris by 5 percentage points. So the Republican Party actually thinks that they have a chance to actually flip this state, not only at the governor's level, but maybe potentially come in about 3 years' time in the next presidential election cycle.
Romain, looking forward to your coverage. Thank you, sir. Romain Bostic on the ground over in New Jersey. He'll be tracking that race throughout today on Bloomberg TV and on Bloomberg Radio. Affordability, Lisa. I've seen some of the campaign ads from both sides, and a lot of this comes down to affordability. We've seen the same thing in New York City. That is a national issue right now. In fact, for a lot of the West, including Europe, it's an international issue.
It's the economy, stupid. Again and again, this is a reason why there's been such a focus on housing from the administration. This is why people are talking about the grocery stores. A question here about what approach is going to actually win out and what that means for how politics are going to be colored going forward, because ultimately it's just a disagreement on how to solve the problem, not necessarily what the problem is.
Meera Pandit at JPMorgan Asset Management still with us. Meera, let's talk about this economy and what it means for this market. We've got a K-shaped economy. We've got a K-shaped market as well. That's fueling the politics that Romain and the team were just talking about throughout the most of this morning. For you, does that matter? Is that a feature or a bug of the equity market? We can park the inequality, the politics, let the politicians take care of that. For the equity market, is that necessarily problematic?
It's not necessarily problematic for the equity market. Of course, it is more problematic for the overall economy. But I think from an equity market perspective, we tend to see that investors are upper income, upper wealth, and so some of that wealth effect is certainly accruing there. But equally, you still see that it impacts people in the long term at every income level when you think about pension funds, retirement. And the structure of the equity market has also changed over time in the fact that we do see more passive flows, 401k flows, and the retail investor becoming such a more prominent market participant. So to the extent that some of the the lower parts of the K are involved in that market, it's helpful, but it's really more of an economic question than it is a market one when we think about what can continue to drive the market higher.
At the same time, there's a real question about whether you can get a broadening out in the overall market performance if you don't get a broadening out with the overall economy. We were talking to Torsten Slok earlier about a K-shaped market in tandem with a K-shaped economy. At what point do you think a rate cut is needed to get that broadening out, or do you see it happening or expect it to happen even without it?
We are seeing some degree of broadening out. So if I look at the best 50 performing stocks in the S&P 500, you can see that 9 out of the 11 sectors are represented. And of those best 50 stocks, only 2 are Mag 7 right now. And last week, or about 2 weeks ago, none of them were Mag 7. It's really been a result of earnings that have boosted them back into those top 50, which I think is a good thing because they've earned their way back into that cohort. But the biggest is clearly not the best right now. However, the concentration issue there is less about Mag 7, non-Mag 7. It's about the AI theme, because you still do have a sort of K-shaped market in that the AI stocks and beneficiaries, whether they're in tech or not, because you see them in industrials and utilities coming into the fold, are the ones benefiting over the rest of the market. So I do think as investors, we need to look for opportunities outside of that. And one of the biggest ones I've seen coming out of earnings season is within financials. It's been an area over the last couple of weeks and months that has softened a bit. And yet, if you look at the fundamentals there, if you look at that increase in S&P 500 earnings over the course of this quarter and that growth, the largest contributor in terms of sector is financials. All 5 of those subsectors are seeing double-digit earnings growth. And when you think about some of the broader drivers, macro environment still at a high level is okay. Look, financials are exposed to that lower income consumer because they do offer debt. So if they're getting a decent read right now and are not so worried about loan losses, that's a good sign. And then what you're seeing from a deregulation standpoint is you maybe don't see these sweeping proclamations of deregulation like you've seen in other areas of policy. But that passive deregulation, when companies feel more comfortable about the regulatory environment, certainly does seem to be helping.
Best performing stock on the S&P this year, Robinhood. Doesn't that speak to the moment?
Yeah, the Robinhood and sort of the meme stock trend and how much that's driven all volumes.
Meera Pandit, thank you. It's good to see you, as always. Meera Pandit at JPMorgan Asset Management. There's another man looking to take from the rich and give to the poor. It's the main event a little bit later in New York City. You didn't like that, Bramo?
I think it's,
no.
Isn't
that the moment? That's what I was trying to speak to.
Yeah,
like,
I think that that's good. I think that that's,
okay.
I don't know. Yeah, maybe he would embrace that.
That's what I was trying to get at.
I think that's clever.
I'm sorry.
I think that's
All right,
good.
we're going to move on. From New York, you're watching Bloomberg TV. This move is sticking, at least for now. We're down by more than 1% on the S&P, down 1.5 on the Nasdaq, down by 1.4 on the Russell. The opening bell about 60 minutes away. In the bond market, shaping up as follows: 2s, 10s and 30s. 2s at 358. Very defensive this morning. Yields down by 2 basis points on 2s, down by 1 basis point on 10s, on 30s. Just about stable. This came from Andrew Hollenhorst of Citi just moments ago. Send in the doves, where Hammock, Schmidt and Logan are more concerned about upside risk to inflation. Daly and Cook are more focused on downside risk to employment. Throw in Myron as well. This committee is as split as it's ever been.
And right now, Fed Chair Jay Powell is not exactly controlling the message when it comes to giving some unity to all of them. So that's why we keep talking about what's the reaction function. We don't have data. We don't have a reaction function concept from the Federal Reserve. So people are looking beyond 2026 and saying we will have a reaction function then, and it will be very different than trying to parse all the differentials here in this particular committee.
I've got a little bit of sympathy for Chairman Powell right now. It's difficult to reflect a consensus that does not exist on the committee, 1 and 2. As Bob Michael at JPMorgan put it, we know he's a lame duck Fed chair going into May, and we know there's going to be a change at the top of the committee.
Honestly, it's clever that he said we're in a foggy street, so we might as well drive a little more slowly. I mean, when you're in doubt, just, delay. And that seems to be what they're doing right now.
December is not a foregone conclusion. Far from it. It was scripted. It was repeated. It was heavy in intention. And you get the feeling he wanted that to be the headline in the news conference last week.
He wanted to push back. He wanted to inject some uncertainty into the market pricing, which had been an incredibly high chance of a rate cut in December. When you take a step back, it raises a question about what this committee is looking at the labor market, how much they're looking at actual weakness, how much they're finding it in the actual numbers versus the unemployment rate, and whether they actually care about inflation. Beth Hammack, yes. Lori Logan, yes. Some others, not so much. They're saying it's going down, and that is the direction that will keep on heading.
That headline from Chairman Powell was the most accurate thing he said in that news conference, given everything we've heard since then. December is a far-gone conclusion. Far from a far-gone conclusion. Right now, we're negative by about 1% on the S&P 500. Let's get you an update on single names. Your morning movers with Yahara Anand. Hey, Yahara.
Hi, John. We are seeing shares of Hertz soaring 22% in the pre-market after a big turnaround quarter for the company as it returns to profitability. Adjusted EPS coming in at 12 cents a share, handily beating the 3 cents expected. The company says its fleet refresh and a back-to-basics strategy helped get more cars on the road than ever. Remember, Hertz struggled significantly as it overestimated how many people wanted to take EVs on road trips. Moving on to another transportation name, Uber. Those shares falling 8.4% in the pre-market despite posting their strongest growth since 2023. Gross bookings jumping 21%, handily beating estimates. So why the dip? Well, expectations were high with the stock up 60% year to date. Plus, Uber did highlight some legal costs that put a dent on profits. And we end on Norwegian Cruise Line Holdings. Those shares also down more than 8% in the pre-market after the company warned the final quarter of the year will be softer than expected and that its yield growth, so the amount of money that it makes per passenger, will also be softer than expected. So another sign of consumer strain showing up in earnings results. John?
Or just improving taste. One or the other. Yahara, thank you. You don't have to comment on that. You know how I feel about cruises. Foregone conclusion. I can speak now. Far from a foregone conclusion. Anyway, let's turn to the Federal Reserve. Governor Lisa Cook giving her first policy speech since President Donald Trump tried to remove her from office back in August. Bloomberg's Mike McKee joins us now for more. Mike, give us a summary of the communication we've had from the Federal Reserve in the last 24 hours.
Well, it's a little more than 24 hours, John, because we go back to Friday when the blackout lifted. We have had a number of Fed officials giving their spin on what happened at the October meeting. And we've put together, in honor of Election Day, a sort of political poll of what Fed officials are thinking about right now. You've got 3 who are voting pause, 3 who are undecided, and of course, 1 who we know is going to want to cut no matter what. You're right about Lisa Cook. She made her first remarks since the president started going after her job yesterday, and we put her in the undecided category, even though you might make the case that she's leaning towards hold, because she says, I see the current policy rate as remaining modestly restrictive, which is appropriate given that inflation remains somewhat above our 2% target. What she did not talk about, of course, was her legal case. She thanked people for their concern, but said because it's an ongoing legal case, I'm not going to talk more about it. We do have a number of Fed officials speaking the rest of this week. We'll be able to fill out more of that survey, although I do want to ask why people on Wall Street care so much right now, given the fact that we're more than a month away from the next Fed meeting. And if we do get a government shutdown ending, we're going to get an awful lot of data between now and December 10th. And a lot of people could change their minds.
Mike, how reliable would that data be? Given data collection issues, you know this better than most. Can you just describe the process to collect the data from the previous few months?
Well, of course, it depends on the data that you're collecting. The September data is pretty much all in, and so we should get September data relatively quickly, including the jobs report. The issue is going to be in the jobs report and the inflation numbers for October. Inflation in particular, because BLS officials, workers were not able to go out and collect the prices that they normally get. They can get a certain percentage of them via the internet, and so they may be able to put out a somewhat truncated CPI report. The jobs report, we can get the number of people who are on payrolls. That most of that comes in electronically. It's the unemployment report, which is a telephone survey, which could be a bit of a problem. So we're not exactly sure when we would get anything from October and how valid it's going to be.
Mike McKee, thank you, sir. Tracking the Fed speak from the committee following that decision last week to cut interest rates, but plenty of debate by whether we should have cut at all or should have cut more. Kathy Bostjancic of Nationwide writing, we maintain our forecast for an additional 25 basis point rate cut at the December meeting. However, given the deepening split within the FOMC, it looks to be a closer call. Kathy joins us now for more. Kathy, good morning.
Good morning, Jeff.
That word, you're precise, more precise than me, deepening. Things are getting worse. You actually think they're becoming more divided on the committee, not less?
Oh, absolutely. And it's been a progression. You've seen that, right? And it makes sense as you start to decide, how many more rate cuts you get to neutral, and do you even eventually need to get accommodative? The first rate cuts are easy, and then it gets more difficult. But this is, I think, the most divided Fed I can recall, frankly, at a really pivotal time, at the same time. And we lack the data, as you mentioned. So it makes it even more difficult, I think, for them to gain a consensus on the committee.
You could make an argument it's not just a political division, that this really is a division about what's going on in the economy. You talk about a deepening strain in the labor market. Other people say it's actually reaccelerating and it's poised to reaccelerate further at the beginning of next year. How do you gauge the depth of the weakening that some people are saying is a reason for the Fed to be cutting interest rates?
Yeah, so I think, it comes down to two things. I think one, it's the employment and the inflation picture, right? Do you think inflation the increase is going to be temporary? And I think also the degree of that. So far, it's been moderate. And then on the labor market side, are things really softening to a degree that warrants, further rate cuts? And we think so. And it's not just a supply story. You're seeing it on the demand side. And that means it's more cyclical. And we saw this even before, the most recent rate cuts and before AI really came onto the scene in a big way, right? We were seeing that the cyclical parts of the economy were not hiring in a very big way. So I think that's the concern. And I think policy has been restrictive this whole time. And we're just not as worried. Inflation's something to watch, but we're not worried that this is the start of a new inflation cycle.
How do you reconcile the fact that you see it as a restrictive monetary policy from the Federal Reserve? How do you pair that with the financial conditions that we're seeing, which is record highs, not today, and a very open credit market? How do those two stories square?
Yeah, so one of the things I think has really been interesting is Fed Governor Waller has spoken about a difference between overall financial conditions and financial conditions for the consumer or everyday Americans. And we're building that indicator just because he mentioned it. And I think it really is worthwhile. If you look at auto loan rates, right, or mortgage rates, the fact that the Fed is far from a foregone conclusion, yields backed up. So that means auto loan rates went higher, mortgage rates move a bit higher, and other consumer rates. So yes, credit conditions, bond spreads are narrow. The equity market is soaring overall. That doesn't mean that borrowing rates for the average consumer is low, and their financial conditions, I think, are tight right now.
Kathy, can we address something Lisa's asked quite often? How much influence do they have over Main Street borrowing and those kind of indicators, those kind of measures?
Well, not directly, right? Of course, they directly impact the Fed funds rate and then maybe influence rates directly out through 2-year yields. But it does feed through, right? And it's a series of rate cuts. It's not just do they move today or in December. It's more about the trajectory. And I think they have influence. We have seen 5-year note yields come down, 7-year. That's where auto loan rates are based off of. And so I think it is important that they look at that as well and consider that when they're debating.
You've identified another split because on the committee, we saw from the Kansas City Fed President Schmidt, he came out and gave a big statement. And in that statement, basically identified financial conditions, the one that Lisa looks at, as being problematic and saying there's no sign that things are too tight. Governor Waller saying something completely different. Governor Waller also coming on this program, he sat in your chair, in your seat, and he said, I don't think that's my mandate. That's not the dual mandate. We shouldn't be focused on those financial conditions, whether equity markets are at record highs or credit spreads are super tight. Do different officials interpret that mandate differently?
Well, it's appearing that's the case more so. I mean, because it used to be, and I think really Fed Governor makes a good point. I think it used to be that you would look at overall financial conditions. And I think it's not just members of the committee, but I think in general, economists were looking at that. But I think when you look at, the bifurcation, the K-shaped economy, you're seeing that in financial conditions right now, too. And when they suggest they're not going to cut rates, we saw the back up in yields immediately.
So will 25 basis points a rate cut actually help consumers that much? Or will it just inflate a bubble that you're seeing, or inflate whatever you want to call it, elevated valuations in the rest of the market, right? Does it actually help narrow or widen the K?
So in my view is it does help. And again, it's not just the 25, let's say they go in December, but if we get further rate cuts next year, it's again, if you go out along the maturities, the 5-year, the 7-year, 10-year, they're pricing in future Fed policy, right? So that path, that does have a big importance. I think what's happening in the equity market, I think a lot of it's driven by AI, right, and tech. I don't think it has anything to do with interest rates, or very little. There's this euphoria that's taken over the equity market.
So, John, let me get this straight. We don't know the reaction function from the Fed.
No.
Not getting data, not understanding exactly what the mandate is of the Fed, and we don't know what the Fed is going to look like next year. Just want to make this straight. So we're trying to game out Fed policy, and there really is not a lot of guidance here.
I think you're describing a leadership vacuum.
Thank you. That's probably a more concise way of saying it.
It's the one criticism that people might have for Chairman Powell right now. In fact, Bob Michael of JPMorgan alluded to that last week, that the division you're seeing on the committee, the fractured news conference we got, all the Fed speak you're hearing right now, for Bob, he believes that's a sign of a Fed chair that's lost his grip on this committee.
Yeah, and on some level, part of that is by design, because he is a lame duck. But at what point does that raise the possibility of a policy mistake?
Well, I agree with you. I think he has lost some control of the committee, and he is somewhat of a lame duck. So you're looking ahead to next year, who fills his seat, right? And what's the other composition? And how does the data play? I mean, I think at the end of the day, the data is going to really call the tune. We do need the government to reopen. In the meantime, we do have private sector data, and I think that is useful. It's not the gold standard, but it's useful. But I think at the end of the day, we'll see what the data tell us. That will clear up things greatly.
Look, we hope, because we've been looking at a low churn labour market for years now, not months, and I think it's to state the obvious that this cuts one way or the other, but it's difficult to know which way this breaks. We have equity investors on the programme who believe the worst of it is behind us, and 2026 is going to deliver a re-acceleration. If that's the case, half the committee is going to look really, really stupid. And if they're wrong, the other half is going to look really, really stupid. And in about 12 months' time, we'll look back and say it was all so obvious 12 months ago. How did they get it so wrong?
To me, the message is going to be, it's not obvious. This is the biggest muddle I've ever seen. And frankly, I think a lot of people are trying to come up with some conviction. Their conviction is to trade around the margins. So if there's enough of a dip here, do the technical buying here, because there is such a lack of clarity over which way this labor market is going to break.
Kathy, good to see you. In person, too. This was nice. Thanks for being here.
Thank you, John.
We appreciate it. Thank you. Kathy Bostjancic there of Nationwide. In the equity market at the moment, pulling back on the S&P 500 by about 1%, about 47 minutes away from the opening bell. Let's give you an update on stories worldwide. Here is your Bloomberg brief. President Donald Trump threatening to withhold federal funding from New York City. A last-ditch effort to drive the city's voters to the former New York governor, Andrew Cuomo, and prevent Zohran Mamdani from winning the mayoral election. Elsewhere, First Brands suing its founder, Patrick James, for allegedly misappropriating hundreds of millions of dollars. Lawyers for the company alleging James borrowed funds on fraudulent terms and diverted cash for himself and his family. And finally, Norway's sovereign wealth fund coming out against Elon Musk's $1 trillion pay deal at Tesla. The fund is planning to vote against the package, saying it is worried about the size. Norway's $2 trillion fund is among Tesla's top 10 shareholders. More on that story throughout the week. That's your Bloomberg brief. Up next, we'll set you up for the day ahead. Plus, we'll catch up with Bloomberg's Michael Ball with the latest tech rally on pause. Palantir down to the pre-market. Equities down across the board on the S&P 500 negative by 1%.
Financial conditions are very easy. So in that sense, companies, especially in the AI space, they're not borrowing as a function of the Fed funds rate. They're borrowing as a function of equity prices. And given where equity prices are for the Magnificent Seven, that's very importantly coming a very significant tailwind still to the economy.
Torsten Slok of Apollo following Alphabet's big issue yesterday, $17.5 billion bond issue, $90 billion order book. Just stellar, absolutely stellar demand for that. And likewise Meta last week. Seen it from Oracle in September. It's just been building now for months.
If there is demand, supply will come. At least that is the Wall Street rule. And that's what we're seeing in the credit markets because there is a lot of demand, a lot of cash, which is looking for income. And a lot of these tech players are saying we are happy to give you that income because it is peanuts for us and we need to build out huge data centers. And that's what's going on in credit.
We'll get into the competition between credit and treasuries and the broader fixed income environment in just a moment as we count you down to the opening bell. Equity futures at the moment down by about 1% on the S&P with the cash open about 50 minutes away, 41 minutes away to be precise. On the Nasdaq 100, we're down by 1.5%. On the Russell, we're down by 1.4%. That's the price section. Here's the day ahead and a trading day for the week ahead too. Today, election day in America. Key races in New York City, New Jersey, Virginia. Elsewhere, earnings from AMD after the close on Wednesday. More data, ADP data, ISM services and earnings from Qualcomm, plus a Supreme Court hearing on President Trump's tariffs. Thursday, a Bank of England rate decision and a slew of Fed speak. More to come, believe it or not. On Friday, UMich consumer sentiment going into the weekend. Going into the opening bell, let's stick with markets. The rally on pause leading up to the cash open with Wall Street bosses warning that tech valuations may be too high. Bloomberg's Michael Ball joins us now for more. Michael, good morning. It's good to see you. Morning. Thanks for dropping by. Look, we've got some pushback, and it's interesting to get the pushback when we get good news. And Palantir is a decent example of that this morning.
Yeah, here we go again. We had this last week, a lot of beats, and yet the next day the trading was underperforming the SPX. And Palantir clearly doing that this morning, showing that the price was already a little too high and the results were baked in. And although they met on all metrics in many ways, people were stretched.
Is something building here, Michael? Palantir this morning, Meta last week. Lisa was mentioning we're not getting pushback in the credit market, but we're seeing pushback in equities to the valuations.
Yeah, I think so. And I think everything is actually going kind of as planned because the numbers are really good. And it is showing there is something tangible here. We're not yet at a point where the narrative is becoming decoupled from fundamentals. There is a strong story here for growth in the AI sort of world, and it's going to be going on for a while still. But as always, equity markets tend to get ahead of things, whereas credit can be more constrained. And that's why we're seeing some of these massive pullbacks after earnings where you're buying kind of into it, you're stretched with either call skew going up or people generally being overlong, and then boom, you get your results, you take your profit, or it just basically means you were in a weaker hand.
It feels like there's a technical underpinning here too, because a lot of the momentum trades have been flagging over the past couple of weeks. I'm talking about Bitcoin and gold, and we're seeing a reversal of a number of these trends, in addition to some of the meme stocks that have arisen over late. I'm just wondering, is this a technical trade, or is this something that has legs? I mean, is there something built in the pipeline that you could see pushing this trade continue to drive this market lower just on the basis of positioning?
Yeah, I think it is a little bit technical because positioning, like we just said, was stretched. And I saw that often in the option markets when you'd have vol up, spot up days, which indicating people were buying into sort of a higher VIX and bidding up the vol aspect of that. Not to get too technical on that. But to me, it means just weaker hands. And again, this is what we see when we have the sell-offs off the earnings results. But as far as the fundamental story, no, I think there is a tangible story. I think there will be ebbs and flows, as we've heard from other guests this morning. And ultimately, where it goes, anyone can guess, because this is such a pivotal new thing.
Another way of saying this is how much more unwind is there, right? So how are hands still weak, right? Is there still more to go for people to get blown out of their positions?
Right. So I guess as we've gotten through most of these earnings now, one would think that as most of the bellwether mega caps have resulted, you've now cleared out positioning better. From what I see on the screen, call skew has come off, put its back, so people are bidding up downside protection, creating a floor, at least at the index level, and individual stocks are a little bit different, so we don't need to go into that. But yeah, I think we've seen a little bit of froth come out. Does that mean there's more to go? Yes, but what are the catalysts next? That's what I've been questioning, and I'm not quite sure.
Should we turn to credit just briefly? Sure. The amount of issuance we've had, Alphabet, Meta, Oracle before that. Do you think this was pushing treasuries around yesterday?
Yeah, I had a couple conversations with traders. They're definitely worried about the longer term theme of being crowded out. Interestingly, now we have kind of a risk-off bid back into treasuries, so that should work in favor. But yeah, look, there's a lot of paper coming. And when you start talking about some of these 40, 50-year deals at the sizes they're coming in, that's going to impact and that's going to affect auctions in the future.
How helpful is it that the Fed's ending QT?
It's actually pretty helpful for the front end. We've clearly seen a lot of kind of volatility there. That's put the basis trade again back in focus as kind of you can't really have repo vol. They're going to be buying a lot of bills. So let's be clear. This isn't necessarily going to make its way out the curve as they come in with open market operations. It's going to be very bill heavy, as we would expect. But it does set a level on the kind of the rate vol complex in the front end that will help benefit the curve.
Can we just say that the Sell America trade has ended and is dead and that is buried? Because what we're seeing right now is people going into treasuries as a haven trade again, not even questioning it.
Dollar this morning.
The dollar this morning.
Dixie's at 100.
Right. The Bloomberg Dollar Spot Index at the highest level going back to May. Is this the end of that?
Yeah, it's a great question. And, everybody's sort of tuned out President Trump in a lot of ways as we've come through now the tariff noise with China finally being kind of the last big leg there. Obviously, there's still some more details to be hashed out. And that's what really kicked it off, right? Because we're going to attack our capital accounts. And was sort of this Stephen Myron plan to come in. Now, he's obviously changed roles now and changed his tune. But overall, that story now has definitely come off. And just real quick, we haven't seen Sovereign Wealth Fund. We haven't seen these other tools that the administration was going to use to basically affect our trade account, which would then be the Sell America kind of oomph.
So has that been unwound in terms of the pent-up shorting and the hedging and the ways that people are trying to do it without actually having to sell U.S. assets? Has that been blown away?
That's the question, because we were all still expecting a lot of hedging from some of the pensions and some of the bigger institutional money in Canada and Europe. Look, that's slow moving, and we don't really get a sense of when that comes in. But to your point, is that done? Maybe, maybe not. Now that we've seen some strength in the dollar, there's probably less urgency. Who knows what those conversations are around the board? But again, it takes a while for these decisions to be made.
Michael, good to see you. Thanks for dropping by. Michael Ball there of Bloomberg breaking down some of the price action. It was like a heartbeat in April, wasn't it? Sell America. Here we are 6-7 months later. It's like the world's moved on again.
Well, people were saying it in a lot of board meetings, especially outside of the U.S. They were angry. But those conversations are, we should probably diversify. Okay. And then maybe we'll take it up in 6 months. And so now the 6 months is coming up. And now the question is, do you actually do it?
Price action shapes narratives. We had this massive outperformance in the rest of the world, European banks, to be very, very precise, at the very start of the year. And that collided with this conversation about Sell America. Here we are, 40% rally later. That's gone.
Especially with the AI trade. And how much does that dominate everything else?
Coming up tomorrow, Cameron Dawson of New Edge Wealth, Jim Zauter of Apollo, Matt Stuckey of Northwestern Mutual, Mike Gapin of Morgan Stanley. Looking forward to seeing you tomorrow morning from New York City. Good morning.
Day 3 at the WTA Finals in Riyadh. Elena Rybakina clinched her spot in the semis with an impressive 3-set win over Iga Swiatek. The number 6 seed continuing her excellent run of form. Amanda Anisimova kept her hopes of advancing alive as she won the All-American matchup against Madison Keys. The defeat eliminates Keys from the tournament. Anisimova will face Iga Swiatek for a spot in the Final Four.